standards on audit, and this entire standards on audit chapter we are going to cover it as a part of this chapter. So before we dig deeper into the standards, first let us try to understand the different categories of the standards which the institute has released. So we have something called Auditing and Assurance Standards Board, which is working under the leadership of ICAI, and they are working for harmonizing and bringing the improvements in the auditing and assurance professions, whatever assignments we do, to improvise it or to bring the harmony in that. So this AASB, under the guidance and the leadership of ICAI, they are giving different kinds of standards, and they have given four categories of the standards. How many? Four categories of the standards they have given, which are standards on audit, then we have standards on review engagement, standards on assurance engagement, and standards on related services. So let us try to understand when which standard will become applicable. So first we will talk about SAs. SA stands for standards on audit. These are the standards which will become up. These are the standards which will become applicable when you as a chartered accountant, when you are performing a audit engagement. When you are performing what? Audit engagement, that too of historical financial information. So when you are performing audit engagement, that too of historical financial information, then you are required to apply the content which is given in SAS. Now, and what kind of engagement audit is? Say reasonable assurance engagement. So in audit, we try to obtain reasonable assurance. And reasonable assurance is a high level of assurance. It is not a absolute assurance. At the same time, it is not a low level of assurance. It is not the medium level of assurance also. It is what? High level of assurance. We will not get 100% guarantee, but we'll try to get the highest level of assurance, where we try to perform audit procedures, we try to get the evidences, we try to check the supporting documents, we perform analytical procedures, we follow different methods, and unless and until we get sufficient and appropriate audit evidence, we will not give that opinion. So that engagement is audit engagement. So whenever you are doing audit engagements, that too of historical financial information, then SS will become applicable, then standards on audit engagement will become applicable. Then we have something called SREs, standards on review engagements. These standards will become applicable whenever you are doing something called a review engagement. So what is the difference between audit engagement and review engagement is? Yeah, so in audit, we obtain reasonable assurance, high level of assurance. But in the case of review engagement, you obtain something called limited assurance, very, very limited. So frankly speaking, in the case of review engagement, we will not even check the supporting documents also. Just we will do overall verification. Like listed companies will prepare something called quarterly financial statements. That quarterly financial statements, will they be verified by the auditor or will they not be verified by the auditor? They will be verified by the auditor. But that verification, we don't call it as audit. That verification, we call it as what? Review. In the case of quarterly financial statements, what auditor will do is just auditor will check the overall presentation, the profit figures calculation and all. So presentation perspective only he will check. He will not go into the supporting documents. If at all required, some minimal analytical procedures he will perform. But opening the documents, checking the supporting documents, all that he will not do. So that engagement we call it as limited assurance engagement, and they will become applicable when a chartered accountant is performing review engagement of, once again, historical financial information. Then SREs will become applicable. Then we have something called SAE, standards on assurance engagement. These standards will become applicable when a chartered accountant gets associated with other than historical financial information. What? Other than historical financial information. When I say other than historical financial information, it could be a non-financial information also. It could be a future financial information also. When I say non-financial, when I say other than historical financial year, number one, it could not be altogether a financial information. It could be he could be doing some assignment with relating to non-financial information, or he might be doing some assignment relating to future financial information. So when he is doing some engagement regarding non-financial information or future financial information, then which standards will become applicable? SAEs will become applicable. If I have to give you example, non-financial information, you can say internal controls. In some engagements, you will do something, you will verify only internal controls and give a report. So that engagement is a non-financial information. So their assurance engagement, SAE, will become applicable. On the other hand, future financial information, prospective financial information, we say. So whenever you are concerned with prospective financial information, like projections, estimates, at some place I have used this example. So sometimes you will be required to prepare projections and all. I think while explaining assurance engagement as a part of nature, objective, and scope of audit. So in case if you are concerned with future financial information like projections, estimations, prospective financial information, then also you are required to follow something called standards on assurance engagement. And here the assurance which you will be offering is moderate assurance. Here what they say, moderate assurance, somewhat mid-level. So if I use simple terminology, low level of assurance, review. Mid level of assurance, assurance. High level of assurance, audit engagement. Clear? So whenever you are doing any engagement which is associated with other than historical financial information, then SAs will become applicable. Then we have finally something called SRS. So what is SRS? Non-assurance. Yeah, you can also say those engagements where you will not give any assurance, where you will perform something called agreed upon procedures, where you will perform something called what? Agreed upon procedures. You agree with the client to perform some procedures, you will perform it, you will not give any kind of assurance. Like for example, one day a client has asked you to prepare the financial statements for them. They already have the books of accounts and all, but they don't know, they don't have an expert who knows who knows companies act and schedule 3. So they have approached you, sir, you please prepare the financial statements for us, we will give you some amount of money as fees. So I accepted the engagement. So as a part of that engagement, I'm not giving any assurance. What I'm doing, I'm performing some procedures which I have agreed with the client. So those kind of engagements, I call them as related services. And whenever you are performing related services, you are required to comply with something called SRS. Clear? So here how the questions they are asking is they're asking differences between reasonable assurance and limited assurance engagement. So they have asked also in fact once. In one case they have asked in question regarding what is the difference between historical financial information and prospective financial information. So and sometimes they have asked a question difference between SAs and SRAs. In one attempt they have asked this question. So better that introductory information is there. I have given you the concept. Just go through the introductory information before you go for the examination, because from there also you are getting a significant questions. Understood? Now all these four standards put together, we call them as engagement standards. All the four standards put together, what do we call them? Engagement standards we call them. Now whenever you are performing any of this engagement, be it audit, be it review, be it assurance, be it related service, you are required to follow one more thing called quality control. You have to maintain quality in all the engagements, whatever you are doing. Whether you are doing audit engagement, whether you are doing review engagement, whether you are doing assurance engagement, or you are performing related services. Do you think is there a requirement for maintaining the quality in all the work, whatever we are doing? 100%. If you don't maintain the quality in our work, what will happen? Entire profession will get blamed. So no, so that's why whatever work we are doing, be it audit engagement, be it review engagement, be it assurance engagement, be it related service, there needs to be what what their quality needs to be maintained. And in order to maintain that quality in the engagements, we have one more series of standards called SQC, standards on quality control. We have, and that we have only one standard, SQC1 we have. So this SQC will become applicable whenever you are doing any engagement. And what does SQC help us out with? It will help us with maintaining the quality in all the engagements, whatever we are doing. Clear? Able to understand everybody? Right. So with this background info, now we will go to the standards. Now we'll start understanding the standards. So we have a few things which we are required to discuss, few standards we are required to discuss. I'll try to explain the overall concept of all the standards, whatever content which is mainly repeatedly tested in the examination, all these things we'll try to cover. So first standard, first series we will take is SA 500 series we will take. So what does SA 500 series? In SA 500 series, entirely it talks about audit evidence. And in the 500 series, we have many things to cover. SA 500 anyhow we have covered. Audit evidence chapter. Audit evidence chapter is completely from SA 500. Apart from SA 500, we have under 500 series, 501 we have, 505 we have, 510 we have, 520, 530. These are actually two dedicated chapters. Then we have 550, 560, 570 we have, 580 we have. So these are all the standards which we have in 500 series. 520, 530, as I have told, this we will discuss later as a part of dedicated chapter. 530 talking about audit sampling, 520 talking about analytical procedures. Remaining all we have to discuss. So first we will pick up SA 501. So what does SA 501 talk about? So if we look at the title of the standard, SA 500, what does that say? What does the title of the standard say? Audit evidence specific, 1 minute, specific considerations for selected items, no? Yes. Right. So here we have. So we will take the chart also simultaneously. Both we will keep it aside. Yeah. So we have SA 501, which is talking about audit evidence and special considerations for specific items. So basically, SA 501 is also the standard which is talking about audit evidence only. But you all will say, sir, we have already covered one standard regarding audit evidence, which is SA 500. Then what is SA 501 for? SA 500 is a general standard which is talking about overall audit evidence. What is the meaning of audit evidence? What are different audit procedures? What are different methods? What is sufficiency? What is appropriateness? What factors will affect? That is a very general standard talking about overall audit evidence. SA 501 is a standard which is talking about how to obtain audit evidence, that too not for all items, only for three specific items. Only for three specific items how you are required to obtain audit evidence. That's what SA 501 is talking about. So how we need to obtain audit evidence regarding three specific items? What are the three specific items which they have asked? Number one is attendance, existence and condition of inventory. How you have to obtain audit evidence regarding existence and condition of inventory. How you need to obtain audit evidence regarding completeness of litigations and claims. And how you need to obtain audit evidence regarding presentation of segment information. So out of that, first thing we will pick up. How do you obtain audit evidence regarding existence and condition of inventory? So here they are talking about two aspects. You need to obtain audit evidence regarding existence and also condition. Existence is something. See, for example, if you find any stock value in your balance sheet, how the stock value will be derived? You have to determine what is the quantity of the stock available, that you have to multiply with cost or NRV, whichever is lower, but you will get a resulting figure that will be the inventory value. So if this inventory value is correct or not, that depends on whatever quantity that you have used in the valuation, that should be correct, and whatever cost or NRV which you are using, that should be correct. If we got to know that quantity is correct and this cost or NRV is correct, then obviously value of the inventory also will be correct. So when I say you need to obtain audit evidence regarding existence, I'm talking about quantity. You need to obtain audit evidence regarding the quantity, whatever quantity that has been used for the purpose of valuation, whether that quantity is really there with the company. And when I say you need to obtain evidence regarding condition, condition is something which will determine the NRV. NRV of the NRV of the stock will depend on what? Condition. So as you all are aware, simple example if you have to take, simple vegetables example if you take, on the day they are brought to the market, they are superior condition. The NRV will be much higher. They will be able to sell it for more. One day passes, their condition will become deteriorated. The price will fall down. The price you are paying is nothing but NRV. Few more days passes, even NRV comes down even further. So when I am trying to obtain evidence regarding condition, I am trying to obtain evidence regarding that NRV. Cost is something you need not worry. Cost you can directly calculate from the books. So what is more crucial? NRV is more crucial. So if you obtain evidence regarding the existence and condition, obviously the value of the inventory will be correct. Now let me ask you. Okay, let us keep the standard aside. You tell me if you want to obtain evidence regarding existence and condition of inventory. If you are in the position of an auditor, assume yourself as an auditor. What you will do to obtain that audit evidence? So what you have to do is, first you have to go and attend. Unless you go and see that, you will not be able to see, you will not be able to know whether inventory is there, what is the condition of the inventory. If you want to know that, you have to go and see it. So what the standards suggest is, management will do inventory verification. Like even in car also we are required to report whether management has done the physical verification at reasonable intervals or not. And what is the reasonable interval for inventory verification? Once in every year they will do. And generally most of the companies will try to plan it around the year end. So many companies will do it as on 31st of March. A few companies will do 5 or 10 days before or after. So many of the companies will plan their physical verification near the end of the financial year. So every company will do physical verification of their stock. Now what the standard suggests is, as an auditor, you try to attend that management inventory counting process. So whenever management is doing physical verification, they will inform you as an auditor, you should try to attend that inventory counting process. Sir, what I should do by attending there? Just time pass, whatever we do regularly. So what you should do by attending that inventory counting is, you have to evaluate the management process. So what processes management is following for doing that inventory counting. Then you observe. First you get the understanding of their plans. Then you sit and observe. According to the plans only they are doing the counting, or they are doing counting in a different manner. Then inspect the inventory. So randomly walk here and there, just have a look on the inventory in what condition it is. And if you are even feeling more bored, perform test counts. Randomly you go to some items and do the counting on your own. Inventory counting will be interesting in some cases. So in some cases, in some clients, what they do know, they will have a very big warehouses and all, and inventory will pile up like very high ceilings will be there. If you want to really go into the stock, they will have some kind of this elevator kind of things and all. They will take you up, they will get you see there. So you can do a lot of time pass there actually, but you have to be very careful, right? So when you go for inventory verification, to those places when you go for inventory verification, no, you go in complete formals and all. For in the morning you get ready, go to the formals and attend the inventory verification. By the evening when you come out, no, you will also get mixed with that labor only. They will not be able to recognize that you are a chartered accountant or an auditor. So whatever it is, as an auditor, if you want to obtain evidence regarding existence and condition of the inventory, management will do the inventory counting. You should attend. By attending there, you should do 4 things. What are they? Evaluate the management's process, observe the management counting, inspect the inventory, perform test accounts. One thing which I got worried a lot by looking at one question in the examination, either in RTPs, MTPs, I don't know. They have asked one question in the MCQs. What is the question? As an auditor, you go and attend the inventory counting process. By attending the inventory counting process, you should do 4 things. Identify which 4 things you should do. 4 options I have given. In each option, you are able to find the 4 things. In every option, all the 4 things are there. But how the options are structured is, option A, evaluate, inspect, test count, observe. Second option, observe, evaluate, perform test count, inspect. Order. In what order? So you have to choose the correct order. So evaluate, observe, inspect, perform test counts. I told the answer. Yeah. Okay. So this is the order. Evaluate, evaluate, observe, inspect, and perform test count. So that order, correct order, you have to find it out and you have to write the answer. So I felt very bad looking at that question. For a moment, I felt like I should quit the teaching and all. I can't see all these horrible things happening. I felt it is really worst question here if you ask me. Hey, why I should do that in that order only? Huh? So first I will evaluate management plans. Okay, then I will sit and observe. I will perform test count, then inspect the inventory. What mistake I have done by doing that? Nothing, no. So, but still they expected an answer. They're not just expecting you to remember the points, but in one case they have even expected you to remember order also. How mean, no? Right. So whatever it is, fine. So let us keep all our worries aside. Let us come back to the concept. If we keep on cribbing, there are many things to crib. One after the one, so many things will come. So let us proceed. So first we will attend and do these 4 things. And one more thing they say here. In case if the inventory verification is happening on the balance sheet date, well and good. Whatever stock which is there on that date, if you are satisfied with that quantity and condition, no issues, you will be happy. Sometimes inventory verification will happen on other than balance sheet date. Say for example, management is doing the physical verification on 10th of April. On 10th of April, they are doing physical verification. You attended there. On 10th of April, whatever condition is there, whatever quantity is there, that is matching. But with that, your responsibility will not come to an end. Why? Because the stock which is there on 10th of April will not come in my balance sheet. The stock which is there on 31st of March will come in my balance sheet. So now you have to do the calculation, reverse calculation you have to do. So if stock on 10th of April is matching, intervening transactions from the date of the balance sheet till the date of that counting, whatever intervening transactions are there, that you need to recalculate. That means you need to add whatever sales which have taken place from 1st of April to 10th of April. You need to reduce whatever purchases which have been done from 1st of April to 10th of April. Then balance stock you have to see, that is a stock as on balance sheet date. Now whatever these additions or deletions which have taken place between these dates, whether they are genuine or not, that also we need to obtain audit evidence. Clear? So whatever it is, management will do physical verification. They will invite you, they will call you, you please go and attend that inventory verification. Next, sometimes what will happen is management will do physical verification. They have even invited you, but you are unable to go and attend that inventory counting. You are unable to go and attend that inventory counting. Then what you should do? Then you alone should go and do then you on your own, if you are unable to go on the date of inventory verification done by the management, then on some alternative date, you plan the inventory verification with your team. But when you go there, no need to do 100% verification. On a sampling basis, you do the counting. That's what you should do. Then, in case you are unable to attend the inventory counting process by the management, later you thought of attending, but it has become highly impracticable for you to attend that inventory verification process. You did not go when the management invited. You thought, okay, I will go after some time on my own with my team and do the test count. But that has become highly impracticable now. You are unable to do it. So, sir, what do you mean by impracticability? Can the auditor say the warehouse where the stock is kept is 50 kilometers away? I have to spend one day to go and verify that stock. That is a reason for impracticability. I will not do. Can he say that? When we say impracticability, that should have been caused by circumstances beyond the control of the auditor. Difficulty of time, difficulty of cost, they are not considered the reasons for impracticability. Able to understand? So you need to compulsorily go and attend the inventory verification on your own if it is, unless impracticable. If it is impracticable, then what I should do, sir? Sir, impracticable examples of impracticability will be like natural calamities, social riots, it could be there, or some dangerous places. Your stock is very dangerous. You can't go and physically verify. Say, for example, your client is dealing in some chemical products. So those chemical products, they are having some hazardous products. They said that some 200 kgs of some material is there. You can't go in surroundings, in proximity, you can't go to that chemical. Even if you go to the proximity also, you have some hazardous effects. So there you can't verify. So that is a reason for impracticability. Sir, I did not attend management's inventory counting process. I thought of going it on my own, but that has become highly impracticable. Then what I should do? Then the standard says try to perform alternative audit procedures. Think, apply your mind. What else you can do apart from doing physical verification? Can you do anything else to obtain audit evidence? Sir, what I can do, that is up to your choice. Sir, someone has come and told, sir, I will do a video call and see. If you feel that that will give you audit evidence, do it. Sir, I am unable to attend, but I have a known person, I have a local person there who can go on my behalf. Natural calamity is there on the way. I can't go, but I know a person at that location where a warehouse is there. I will send that person. Do it. So whatever it is, try to do alternative audit procedures to obtain audit evidence. Sir, alternative audit procedures are also not possible. Might be you thought of alternative audit procedures, but they are not giving evidence, or you did not come across any alternative audit procedures only. Then what you should do? Modify the opinion. Then you don't have any option, you have to modify. Which kind of modification you will give? Which kind of modification? Not disclaimer. I told you, no, you told whenever there is no evidence, you will directly jump to disclaimer, but it is not the case here. It could be either a qualified or disclaimer. If the possible effect of that inventory is only material but not qualified, if the possible effect is material and also, then what is? Then disclaimer we are supposed to do. Understood? Clear and comfortable? Right. Next. In addition to that, they say one more thing. When you go, now if you come to the material, when you go and attend the inventory counting process, there are some matters which you have to pay attention. What are the matters which are relevant in planning attendance at physical inventory counting? So what matters you have to pay attention? You have to pay attention to what is the nature of inventory. Is it work in progress? Is it finished goods? Or is it raw material? You have to pay, if it is work in progress, what is the stage of completion? 30%, 50%, 60%. What is the stage of completion? So that you have to pay attention. Risk of material misstatement. Keeping in mind the inventory, what is the risk of material misstatement here? And also nature of internal control. The place where they are keeping the inventory, what kind of internal controls they have. Whether there are adequate procedures and proper instructions, the staff who are involved in the inventory counting, to them proper instructions have been given or not. The timing, at what time you are doing that physical verification. Whether the entity maintains perpetual inventory system, how they are maintaining the records. Generally, they should maintain perpetual inventory records, not periodic. And the location where the inventory is held, because of that location, is the inventory facing any challenges? Is the inventory facing any risk? And also whether the assistance of an auditor's expertise is needed. Sometimes to obtain evidence regarding inventory, you might need the assistance of an expert, especially when the quantity is in the form of liquids. Like oil refining company, you're doing the audit, they store the oil in very big containers. The container will be equal to the length of a building and all. They say in this container we have 2000 liters of oil. You have to measure whether really 2000 liters of oil is there or not. What do you do? Take a bucket, tie a thread, tie a rope, and start extracting. Can you do that? No. So you have to take an expert of engineers. They're depending on the dimensions and all, they will give you some kind of estimation. So like this, whether you are required to take any help of the expert, that also you have to pay attention. So these things you will try to obtain, these things you will do to try to obtain audit evidence. Sometimes what will happen is your client is owning a stock, but that stock is not with your client. That stock is held in possession, is in the custody of a third party. Someone else is holding that stock. Now what auditor should do? In case if the inventory is getting held by some third party, so for that also you need to obtain audit evidence. So how you will obtain audit evidence? You will try to obtain external confirmation. Generally, external confirmations will be reliable. See, when this circumstance will arise is in the case of job work, in the case of goods sent on consignment, in the case of goods sent on sale or approval basis. So in those cases, this thing arises. So in those cases, for that also we need to obtain audit evidence. But first thing what we do, external confirmation we do. Generally, external confirmations are reliable, but in some cases, external confirmations are not reliable. When the third party from where the stock is kept, they are not independent, then you need to perform alternative audit procedures. What alternative audit procedures you can do? If possible, you go and attend there. If the time permits, you go and travel. If you know somebody else, go and ask them to go on your behalf. So like that, whatever you feel appropriate, in addition to external confirmation, that extra procedures also you are required to perform. Clear? So this is what SA 501 says regarding obtaining of audit evidence relating to existence and condition of inventory. Second item regarding which you need to obtain audit evidence. Second item regarding which SA 501 is giving guidance. What is that? Completeness of litigations and claims. Whether management has completely whatever litigations and claims the company is going through, the client is going through, without ignoring, without leaving anything, everything should have been presented in the financial statements. See, every litigation and claim, if because of a litigation and claim, if we know that we are going to compulsorily lose the case, that will be shown as a provision. That amount will be shown as a provision. If outcome is uncertain, then it has to be shown as a contingent liability. But somewhere litigation and claim should be completely presented. So as an auditor, you should obtain audit evidence whether the company has disclosed all the litigations and claims either in the balance sheet or in the notes to accounts, and whether have they hidden anything from you, that you need to obtain audit evidence. Sir, how I need to, what steps I need to do in order to obtain the audit evidence? First, the standard says don't directly go for finding out the misstatement. First, you try to find out, is there a risk of material misstatement? Is there a risk of material misstatement regarding litigations and claims? What do you mean by having a risk of material misstatement regarding litigations and claims? Is there any chance that the management could have hidden some litigations and claims? Find the risk. Sir, how will I find the risk? They say 3 steps you have to perform to find whether there is any risk of material misstatement regarding. Listen carefully, guys. Listen. Don't put your heads down. Listen carefully. So you need to first identify risk of material misstatement. They are not asking you to directly identify misstatement. First, they are asking you to identify risk of material misstatement. How can you do that? By performing 3 steps. First, they are asking you to do 3. What exactly you need to do? They are saying here. So 3 things they are asking you to perform first. What is that? Inquiring with the management and in-house legal counsel, internal legal department and the management. Go and inquire with them. Sir, did you completely disclose all the litigations and claims? Go and talk with the legal team also. Then read the minutes of those charged with governance. Top level management might have conducted the meetings. Go through the minutes. Third one, review legal expenses. What are the legal expenses in the current year? What are the legal expenses in the past year? Do the comparison. If there is any significant increase, there should have been new cases, whether that has been disclosed or not. Clear? So 3 things you are required to do. What are the first 3 things you are required to do? Number 1, inquire with management and in-house legal counsel. Number 2, read the minutes of those charged with governance. Number 3, review the legal expenses. These 3 why we are doing? To identify risk of material misstatement in the area of litigations and claims. Now, by following these 3 steps, 2 outcomes could be possible. What 2 outcomes could be possible? There is a risk of material misstatement, or there is no risk of material misstatement. If you are satisfied after following the 3 steps, you are satisfied that there is no risk of material misstatement. I did not find any risk there. I did not find any chance management hiding. I felt genuine. Management has disclosed all the litigations and claims. You aren't supposed to do anything. Your activity will get completed there itself. Done. If you don't find risk of material misstatement, your responsibility is over. But in case if you find the risk of material misstatement, you perform at these 3 steps. But if you found the risk of material misstatement, yes, there is a chance somewhere some suspicion is there that management might have hidden some litigations and claims. Then you need to perform further audit procedures. Then you need to perform further audit procedures. So what further audit procedures you have to perform? Like even if you see in the chart here, I have specifically mentioned only if there is a risk of material misstatement. No risk of material misstatement, nothing. Your process will end here only. If risk of material misstatement, perform extra. What you have to perform? Number 1, auditor shall communicate with entities external legal counsel. You have to go and communicate with the entity's external lawyer. For the purpose of fighting the case, they might have recruited the lawyer. Go and consult with the entity's external legal counsel. But if you go and ask something to the entity's external legal counsel, they will not respond to you. Why? Because you are not the person who are paying them the fees. So if you need information, when entity's external legal counsel will give the information? Only when you have some kind of approval from the management. Or management will better know if you ask the information in what manner you will get the reply. Yes or no? So I am helpless here. I have to go and take the help of management. So what I should do? How I will take the help of management is, see, generally I will try to communicate with the entity's external legal counsel through a written letter. But I don't know how, if I ask to whom to address, I will get the information. So for this, I have to take the help of management. So I will ask the management. I will tell them the content. I will ask the management to draft that letter of inquiry. So auditor will try to communicate with the entity's external legal counsel through a letter of inquiry prepared by the management, sent by the auditor, and asking the entity's external legal counsel to reply back to the auditor directly. 3 things. The auditor will communicate with entity's external legal counsel through letter of inquiry prepared by, sent by, and asking the entity's external legal counsel to reply back to. Perfect. Now, after you have sent the letter of inquiry, 2 things can happen. 1, what is the first one? Entity's external legal counsel has communicated. He gave the reply. Now we will analyze the reply. On the basis of that, we will form the conclusion. So this audit will proceed normally. So when there will be an obstacle, that means you are not getting reply from the entity's external legal counsel. Not getting reply from entity's external legal counsel might happen because of multiple reasons. Number 1, first, management itself did not cooperate with you to send a letter of inquiry. Number 2, management helped you through a letter of inquiry, but the external legal party, he is prohibited from the law or regulation. Like we have confidentiality, even lawyers also will have confidentiality. So that external legal counsel is prohibited from responding, or external legal counsel intentionally is not providing, even though there is no prohibition, he is not responding. Any of these 3 cases, either management did not help you out to draft the letter of inquiry, management helped you out, but the external legal counsel is prohibited from responding, or he is not responding out of his own. In any of these cases, you will not be able to get a reply. Now what you should do? Now the standard says perform alternative audit procedures. What you should perform? Alternative audit procedures you have to perform. Now once again, it is up to your choice what alternative audit procedures you will perform, that you decide and do it, but try to perform alternative audit procedures to get the audit evidence. Now if alternative audit procedures are also not possible, then what you should do? Then you have to give a modified opinion. Which kind of modified opinion? Qualified opinion you are required to give. Qualified or disclaimer of opinion you are required to give. In addition to that, even you are required to obtain written representations from the management that they have completely disclosed the litigations and claims. They did not hide anything. Ask the written representations also. And in some cases, you might feel that just communicating through letter of inquiry alone will not be enough. Sometimes you will feel the need to go and meet with the entity's external legal counsel directly. The standard says you have to go and meet with the entity's external legal counsel. You have to communicate with the entity's external legal counsel through letter of inquiry. But sometimes as an auditor, you might feel that communicating through letter of inquiry alone will not be enough. You might be required to go and meet with him personally. When that need arises, So here they have given, if you find that that risk is a significant risk, the legal matter is very big legal matter, it is a very significant risk, then not just communicating with letter of inquiry, you can go and meet him personally. And also matter is complex. Matter is very difficult to understand. That legal issue is very difficult to understand. Through letter of inquiry, you are not getting clarity. Then also you can go and meet with the entity sectional legal counsel. Or if there is a disagreement between management and entity sectional legal counsel, that means management told something, we sent a letter of inquiry, he gave a reply, whatever entity sectional legal counsel is saying, whatever management is saying, there is a difference, there is a conflict. Then also you can go and personally meet with him and clarify the issue. So these are the three circumstances where the auditor might feel a need or urge to go and meet that entity sectional legal counsel when the risk is a significant risk, when the matter is very complex, when there is a disagreement between management and entity sectional legal counsel, then you can directly go and meet that entity sectional legal counsel. Generally, the entity sectional legal counsel will not meet you directly. For that also, he will ask you to get the permission of the management, or he will ask you to bring some representative of the management. So then you have to go to that fellows and ask them, hey, come useless fellow, he's not meeting you. He's not meeting me along without you. Please come, we will go and meet him. You have to take him and you have to go and meet him. Clear? And one more small thing is also there here. This is not covered in this chart. A small thing. General letter of inquiry, something will be there. Yes. Yeah, here. So this one. Sometimes what will happen is you might not be able to communicate through a specific letter of inquiry. I told you are required to communicate with the entity sectional legal counsel through a letter of inquiry. But sometimes what will happen is, like if you read this phrase, it is considered unlikely that entity sectional legal counsel will respond appropriately to a letter of general inquiry. So basically, first you will send, sir, what and all cases your client is going through. I'm an auditor of this company. Give me a list of all the cases which your client is going through. Now, external legal counsel will say, get lost. See, he will not respond to the general letter of inquiry. Anybody will have a doubt? No. See, for example, if someone is asking, tell me what and all your client is doing. You are doing audit of some company. Tell what are the various sources of revenue your client is having. Will you just like that reply? No. Even external legal counsel also will be very unlikely to respond to a general inquiry. So in that case, what you should do is you should make a specific inquiry. If you ask him broader things, he will not respond. He will have a doubt why this person need all this information. But instead of that, what you should do is you should ask him a specific inquiry. If you send specific inquiry, the chances of reply are very higher. So for this purpose, a letter of specific inquiry includes the list of litigations and claims. Basically, not the entire list regarding is there any specific doubt you have regarding certain litigation. So that list of litigations you can include. Where available, management's assessment of outcome of each of the identified litigation. You will also mention in that letter of inquiry, sir, these litigations the company is going through. When I asked the management is saying this. They are telling that there are more chances for winning. That's why they did not show it as a provision. They are showing it as a contingent liability. Management is saying this. Then a request that entity sectional legal counsel confirm the reasonableness of the management assessment, and you request the entity's legal counsel, sir, management is saying this, whether is it acceptable or not, or do you have any contrary view. So if you draft the inquiry letter specifically like this, the chances of getting the reply are very higher than the general inquiry. So if you have decided to send the specific inquiry, these are the things which are required to be included in the specific inquiry. What are they? List of litigations and claims. Number 2, management's assessment. Number 3, requesting the entity sectional legal counsel to comment on reasonableness of management's assessment. Understood? So 2 aspects we have covered. Now we are left with last aspect. What is that? Segment information. So whether the management has presented the segment information properly or not, here I have nothing much to explain. Basically, we have an accounting standard talking about the segment information. So whether that requirements of the segment information standard has been complied with or not, we need to check. So as per that AS 17, we have a primary segments and all. We have how to identify the primary segments and all. They will give you criteria. Whether that criteria has been followed or not, we will check. And whatever calculations they have done, is it as per the standards or not, we will check. And if time permit, if suitable, we will also try to perform analytical procedures on the segment information. Like for example, if the business is having, if the client is having multiple businesses in the current year, like Reliance only you take. Last year from petroleum from petroleum segment, they have generated 70% of the revenue. In the current year, they have generated only 60% of the revenue. So I will do the comparison. Why there is a fall? Is it a genuine reason or is it any misrepresentation? So like this, I will try to dig deeper and get the information. Understood? So this is what you are supposed to do regarding segment information. Understood everyone? Shall we proceed further? So that's all. SA 501 has been completed. Now we will talk about SA 505. We will try to discuss, which is relating to external confirmation. So what does this external confirmation talk about? So first we need to be clear about a few definitions. So what is an external confirmation? If you remember, external confirmation is one of the method for obtaining audit evidence. We have discussed the 7 methods. In that, one of the method is what? External confirmation. So what is the meaning of external confirmation? So external confirmation means it is a direct written response. And one important thing you have to keep in mind, if you are getting oral response, that will not be considered as external confirmation. In order to be considered as external confirmation, that response should be a compulsorily a written response. Whether you will get that written response in paper form or electronic form, that is up to your choice, but that should be compulsorily in written format. If you get an email, yes, external confirmation. If you get a WhatsApp message, yes, external confirmation. If you get confirmation over call, not an external confirmation, because it must be in a written format. So auditor getting a written response either in paper or electronic form from whom? From a third party. Which third party? Other than auditor and the client. Other than auditor and the client, from a third party like debtor, creditor and all, from banker, etc. From the third party, whatever direct written response which auditor is getting, that we call it as, and third party we also call it as confirming party, and that written response we call it as external confirmation. And now these confirmations you can get it in two ways. As an auditor, if you want reply, basically in external confirmation, we will ask the information from the other party. We'll ask the confirmation from the other party. That letter which you are sending, that we call it as confirmation request. You want written response, no? For getting that written response, you have to first ask the information either by way of email or letter. That request which you are sending for response, that we call it as confirmation request. And that confirmation request can be of two types. What is that? Positive confirmation request, negative confirmation request. What is a positive confirmation request? In your confirmation request, if you are expecting a third party to respond whether he agrees or disagrees. If he is agreeing also, you are expecting a reply. If he is disagreeing also, you are expecting a reply. Then we call it as positive confirmation request. Then what is negative confirmation request? You are expecting the other party to respond only when he disagrees. You have to determine whether a request is a positive confirmation request or a negative confirmation request depending on the wording used in the confirmation request, not on the basis of you are getting reply or not. So you have to decide whether a confirmation request is a positive or negative depending on expectation of the auditor, what he is expecting. If he is expecting the third party to respond either he agrees or disagrees, then it is a positive. If he is expecting a reply only when the third party disagrees, then it is a negative confirmation request. Understood? Then say for example, one auditor is sending the confirmation request like this. He's saying in the confirmation request, sir, I am the auditor of so and so company. I came to know that you are a debtor of my client. Please tell me the amount you are due to my client company. Positive or negative? Understood the question what I'm asking? See, I'm not asking him for a confirmation. What I'm asking, sir, I'm an auditor. I'm an auditor of your client, of my client. My client says you are a debtor. Please tell me what is the amount you owe to the company. Positive or negative? Positive. Why? Because here also I will get response. I'm expecting response in all the cases. I'm not asking him yes or no. I'm asking him to directly provide information. So there also I'm expecting response in all the cases, no. So that will also fall under positive confirmation request. Next, one more term which we need to understand is exception. Exception means what? Exception means mismatch basically. Say for example, I sent a confirmation request asking my debtor, sir, I'm an auditor of so and so company. My client says that you are a debtor. You owe them 1 CR. You owe them 1 CR. Your outstanding balance in their books is 1 CR. But the debtor replied me back, no sir, I'm not required to pay 1 crore. I'm required to pay only 80 lakh rupees. So information, whatever is there in the confirmation request and whatever response you got from the third party, both are not matching. There is a difference. That case we call it as exception. So here I have an exception. So whenever you come across exception, will you automatically conclude that it is a misstatement? Does an exception always mean a misstatement? No, exception doesn't always mean a misstatement. Exception can also be because of third party's mistake also. When a difference you have got, you don't automatically come to the conclusion that your client has only done a mistake. Sometimes exception might arise even because third party has made a mistake in his books of accounts. So exception doesn't always mean a misstatement. When you come across exception, you have to put that extra effort to determine is that exception a misstatement or not a misstatement. Then one more definition, you need to understand what is the meaning of non-response. What do you mean by non-response? So non-response means one simple thing. You sent a confirmation request, but you did not get the response. This is what generally we issue. But they define this in a detailed manner. Number one, you sent a confirmation request, but it got returned undelivered. You sent a confirmation request, either positive or negative. You sent a confirmation request, but you got it was not delivered, you got it back. Like you sent a post, you got it back. You sent an email, you got a message that the message was not delivered. This we call it as non-response. Or you sent a positive confirmation request. What? Positive confirmation request, and you did not get the reply. Then also we call it as a non-response. If I send a negative confirmation request and if I did not get reply, that also will I consider it as non-response? That you can't consider as non-response. Why? Because in the case of negative confirmation request, that will be considered, the other party is required to reply only when he disagrees. If you don't get the reply, that means he has agreed, that you can't consider it as non-response. So non-response covers two cases. Number one, confirmation request got returned undelivered, either positive or negative. Number two, you sent a positive confirmation request, but you did not get a reply from the third party. Understood? Clear about all the five definitions? Then now let us come to what are the various steps which are involved. If you want to get a proper response from the external confirmation, what and all are the steps which you are required to follow? It involves four steps. Number one, you have to determine the information regarding which information you want to send the confirmation request. Number two, you have to select appropriate confirming party. Number three, you have to design the confirmation request. Number four, you have to send it and do the follow-up also. Let us talk about the first one. What is the first one? Determining the information regarding which you want the confirmation. See, mainly we use external confirmation for confirmation of balances. There is no doubt about it. What is the debtor's balance? What is the creditor's balance? What is the bank balance? So we mainly use that confirmation request for quantitative balances. But do you think the use of external confirmation is restricted only to quantitative things? We can also use it for qualitative aspects, like whether the customer has really given a discount or not. If the property is pledged with the bank, really the property is pledged with the bank or not. Do the bank has ownership documents or not? These kind of things also you can get a confirmation by way of external confirmation. So you can use it for both qualitative as well as quantitative aspects. So whatever it is, first you will determine regarding which information you want to send the confirmation request. Number two, you have to select appropriate confirming party. So you have to choose to appropriate person you have to send. Why? Because if you send the confirmation request to inappropriate party, you can't expect a reply. Even if you expect a reply, even if you got a reply also, that is not reliable. Only when the confirmation request has been sent to appropriate recipient and you got a reply from that appropriate confirming party, then only reliability will be there. Next, third step. Okay, you decided who is the confirming party, got his communication details, and you have sent that. You have identified the party. Now, what is the third step? Design. Now you have to take a decision. Should I go for positive? Should I go for negative? And what various factors you will consider, like risk of material misstatement you will consider. If the risk is high, positive confirmation request. If the risk is low, negative confirmation request. You should also decide on presentation. So you have to send it on paper form or you have to send it on electronic form. That also you have to decide. Even in taking that decision, you can use your past experience also. You can use your previous experience. Whether if you send it by post, you will get a reply, or if you send it by email, you will get a reply. You use your past experience as well. It also depends on the assertion, that respective item of the financial statement. On that also you will decide. And even you have to decide on method of communication. So, and also management authorization. Sometimes what some third parties will do is, if I am an auditor, I send a confirmation request to the debtor. Debtor will see the mail, he will reply back saying why I should believe you are an auditor, why I should reply. That he is having so much of time. If he doesn't feel me as a genuine, he should have ignored. But what that person will do, he will even reply back. Why I should trust you are a genuine person? Why I should trust you are an auditor? Let us do one thing. You get the approval of the management that you are really an auditor, then only I will reply back. Now you don't have any option. What you should do? You have to include the management approval, then send the confirmation request. And also you need to decide whether you want item wise details or you want total information. Say for example, from some person, from some debtor, you want balance confirmation. Instead of asking, you know that debtor is a genuine person, good person, you have already past experience with him. Whatever information you ask, he will share. From that people, you can ask invoice wise details also. He will give a confirmation. Now, some people will be frustrated people. If you ask balances only, they will not reply. Very rarely reply. For those people, if you ask invoice wise details, they will even look your mail, delete your email. They will not reply. So you need to decide whether you want invoice wise details or you want total balances confirmation. Keep all these factors in mind, then design your confirmation request. Okay, after designing, what you will do? Keep it safely in the locker. What you should do, you have to send it, and you have to do the follow-up also. In which kind of confirmation request you do the follow-up? In the positive confirmation request, we do the follow-up. For negative, we don't do the follow-up. Why? Because if you don't get the response, we generally imagine that the third party has agreed with the information. Next. Now, between positive versus negative, which one is more reliable? Positive is more reliable. Negative confirmation request does not. Negative confirmation request does not give that much persuasive evidence. Persuasive. What is the meaning of persuasive? Convincing. Pervasive is different. Persuasive is different. See, positive confirmation request, you get more convincing evidence, whereas negative confirmation request will give you less convincing evidence. Does that mean should you not use a negative confirmation request at all? No, you can use it. You can use a negative confirmation request only when certain things are present. And in fact they use the phrase, don't you can use negative confirmation request as a sole substantive audit procedures only in few cases. Only in few cases you can use negative confirmation as a sole substantive audit procedure. Always using only negative confirmation request is not correct. You can rely only on negative confirmation request only in few circumstances. What are the circumstances? Risk is very high. Sorry, risk is very low. The items are very small, minimal balances, and also homogeneous, small and homogeneous populations, they say. And few more things. Low exception rate. In that area you don't expect any kind of differences. Generally they will be matching only. So then also, like for example, if you take bank balances and all, there is a very less chance for exception because mostly they will match. And also recipient doesn't disregard the request. So what do you mean by this is, you know the recipient very well. As an auditor, you know the recipient very well, that if I send a message, he will definitely respond. If something is wrong, he will definitely respond. He's not a person who will ignore the messages and mail. You know that third party very well. If you know that third party very well, then also you can send a negative confirmation request. If you trust him so well that he will definitely look at the mail, and if he finds something is in problem, definitely he will reply. That much confidence if you have on the third party, then also you can send a negative confirmation request. And also wherever controls are effective. So you can use negative confirmation request as a sole substantive audit procedure only when these things are present. In other cases, you can't rely only on negative confirmation request. Either you have to go for positive confirmation request, or you should use negative confirmation request in combination with other methods. Sir, I want to send a confirmation request, but management is not allowing me to send a confirmation request. Who are the management here to stop us? How they can the question is, why they will stop us? Why do we need their permission first of all? See, stopping in the sense, how they will stop is, as a part of this external confirmation process, we rely on management. Whether you agree or not, we have to rely on the management. At which step we become rely on the management is in the second step. You have to select the appropriate confirming party. Your client has done a business with them with very big company. Now you want to send a confirmation from that big company, from that customer, but you can't send the email to their official email address because they will not respond. So you need to find out, for example, if your client has done sales to them, that means it is a purchase for the third party. You need to know who is that concerned purchase head of that third party and what is his email address. You have to get it. That unless that without the help of management, you can't get it. So yes, more or less, whether you agree or not, in order to send the confirmation request, we need the help of the management. But sometimes management will refuse. So you go to the management and say, sir, I want to send confirmation request to your creditor. I need his details. I need his email account. then the management is saying, no, we will not share with you the details, or they will request, sir, please don't send the confirmation request. Then what you should do? First, you should understand the reasons why they are stopping you from sending that external confirmation. Why they are stopping you? Get the reasons. If there is a valid justification, what you do is try to perform alternative audit procedures. If you are unable to perform alternative audit procedures, you will give a modified opinion. However, if there is no reasonable justification, management is not giving any reasonable justification. They told, sir, don't send external confirmation. I asked them reasons. They are not at all giving me any reasons, or they gave me some reasons which are not at all acceptable. Then what they're asking you to do is reassess your risk of material misstatement. You might have done the risk of material misstatement assessment at the beginning of the audit. Reassess the risk of material misstatement. Why? Because now you got to know about the true nature of the management. Earlier they are saying yes to everything. Okay, sir, do whatever you want. But now they have come to you and showed that true color. No. Now they are telling, when you want to communicate with the third party, they are coming and telling you, no, don't communicate, and they're not telling me any valid reason. Now you got to know extra information regarding the management. Earlier you might have thought risk as low, but now you got to know about the management's nature. Now you should reassess your risk of material misstatement. You should consider the risk as very high. Increase your audit procedures. So reassess your risk of material misstatement, especially risk of fraud, and communicate this matter with those charged with governance, and even if required, modify the opinion. And whatever evidence you are getting it from external confirmation, you are required to evaluate it. What you are required to do? You are required to evaluate whatever evidence you have got it from obtaining external confirmation. So that one last paragraph will be there. So like as you could see, whatever evidence you are getting, that you need to evaluate. So the auditor should evaluate whether the results of the external confirmation procedures provide relevant and reliable audit evidence. Whatever responses you have got from the third parties, are they reliable or not? You need to check it. And when evaluating the results of individual external confirmation requests, the auditor may categorize such results as follows. Whatever responses you have got, you need to categorize them. How you have to categorize? A response by the appropriate confirming party indicating agreement with the information provided in the confirmation request. That means no exception. Everything is matching. See, basically you sent 100 confirmation requests. You got the responses. Now you need to segregate, no? For which, how many confirmation requests are there where the third party has agreed? Then a response deemed unreliable. You got a response, but the third party is not independent. You have a suspicion. Even though he gave a response, even though he told everything is correct, but it is not reliable. That you keep it aside. Then a non-response. You send a confirmation request but did not get any reply. That you keep it aside. And a response indicating an exception. Nothing but differences are there. So you get all the external responses, collect all the external responses and segregate them, categorize them. On what basis? Into 4 categories. Into 4 categories you have to aggregate, you have to separate them. What are the 4 categories? Those which are matching. Those where there are no discrepancies, everything is matching. Those responses which are considered non-reliable. No responses or exceptions are there. So into 4 categories you have to segregate. Then the auditor's evaluation, when taken into account with other audit procedures, it will assist the auditor in concluding whether sufficient and appropriate audit evidence. Now after categorizing into all these 4, analyze them further and finally arrive at a conclusion whether this external confirmation has given you sufficient and appropriate audit evidence. If you feel that no, external confirmation has not given me sufficient and appropriate audit evidence, perform additional procedures. Clear? Other methods also you take the help of. Understood? So this is how you need to evaluate the responses to written representation, sorry, external confirmations. Understood? Clear? Shall we proceed further? Next. So now what we will do is 580 we will do. Very much related to 505. So I say 505 is external confirmation. 580 is written representation. That we will try to do now. Right. So what is written representation? What is the meaning of the written representation? It is also basically a confirmation, a written statement which is obtained by the auditor. External confirmation, we are getting a written response from a third party, but written representation, we are getting it from a management. So written representation is a statement, is a written statement received by the auditor from the management regarding what? Regarding confirmation of certain matters. You need confirmation regarding certain matter from the management. You want the management to confirm certain things. So you ask them to confirm them in a written manner through a written statement. and also to support other audit evidences. You have got some evidences, but you want some supporting information. So to support other audit evidences also, you can ask a confirmation from management. So written representations are written statements obtained by the auditor from the management either to confirm certain matters or to support other audit evidences. Now, can you use written representation as an audit evidence? Yes. Written representation is an important audit evidence like inquiry, but the problem is written representation does not provide evidence on its own. Written representation does not provide evidence on its own. What do you mean by that? You can't rely only on written representation. Written representation is just a supporting evidence. You can't rely only on written representation, but you have to use that phrase, terminology. So written representation does not provide evidence on its own. The other way of saying that is written representation do not provide evidence, you can't only use written representation as audit evidence. That is also same meaning. That is also same meaning. But you should not write it. What you should write in the examination? Written representation does not provide the evidence on its own. Understood? Next. Sir, what are the objectives of the auditor? As per SA 580, from whom, regarding which matters you need to obtain written representation. So, SA 580 says, regarding 2 matters it is compulsory. Not 2 actually, regarding 3 matters it is compulsory. Number 1, every auditor should ask the management to give a written representation whether management has fulfilled their responsibility for preparation of financial statements. Every auditor should ask the management to give a written confirmation that whether they have fulfilled the responsibility for preparation of financial statements. And also every auditor should ask the management to give a written representation regarding completeness of information provided to the auditor. Basically, you should ask the management, sir, did you completely provide the information to me regarding anything? Did you completely provide the information to me? Management will say yes. They will nod their heads. Stop them to nod the heads. Ask them to write it on the piece of paper and give it to me. So 2 matters: compulsory written representation. Number 1, whether management has fulfilled their responsibility for the preparation of financial statements. Number 2, whether management has completely provided the information to the auditor. Third thing where it is mandatory is if there is any requirement of other standard. In other standard, if they are asking you to get the written representation regarding that matter also you need to obtain. Just now we have seen SA 501. There we have seen the second aspect, completeness of litigations and claims. There they have asked you to obtain written representation regarding completeness of litigations and claims. It is mandatory for you to obtain written representation in that matter. Similarly, in SA 570, they will ask you to obtain written representation regarding going concern. It is mandatory for you to obtain written representation regarding the going concern. So 3 cases mandatory. What are the 3 cases mandatory? Management fulfill the responsibility for preparation of financial statements. Number 2, completeness of information provided to the auditor. Number 3, wherever there is a requirement of relevant standard, rest of the matter is auditor's choice. Rest of the matter, if auditor feels it necessary, he will obtain the written representation. Next, what should be the date and period covered by written representation? The date of written representation should be on or before the date of audit evidence. It can never be later than the date, sorry, on or before the auditor's report. I told audit evidence, no, sorry. So the date of written representation should be on or before the date of auditor's report, but in any case it should not be later. Why? Why? Because written representation is also a kind of audit evidence, and the sequence is first audit evidence, then auditor's report. If you take the audit report first and then dated the audit evidence, once again you are showing that you are a fool, which we should not look like, even though we are in some cases. Right. So this is what regarding date and period covered by written representation. Then, sir, from whom you will request written representation? Management. But management is a very broader term. Many people will get included there. All the team of board of directors will get included in the management. But we can't go and ask written representation from everybody, no. We generally go and ask written representation from that part of the management who are having the responsibilities relating to financial statements. Like if there is a CEO, we can go and ask a written representation from CEO. Or if there is a CFO, we can go and ask the written representation from CFO. If there is an audit committee, we can go and ask the written representation from audit committee. So we should go to that part of the management who are directly or indirectly associated with financial statements. Sometimes what will happen is we will ask a written representation regarding certain matter. Like say for example, SA 501, I need written representation regarding litigations and claims. I went to the management, I went to the CFO and told, sir, I need written representation regarding litigations and claims. CFO told, no, sir, I am not the person looking into legal matters. We have an internal legal team. They are looking into the legal matters. Saying that, can he escape? Can he say, no, no, I don't have information. I will not give written representation? Can he say that? No. Then what should be done? So he should go to the concerned person in the organization, get the information from that concerned person, then provide the written representation to auditor. No person can escape saying, I don't have information, I am not getting associated there, I will not give written representation. He can't say it. So he has to go to the concerned person, get the required information, then provide written representation to auditor. Clear? Able to understand? Next. Like this also they have asked. In one exam they have asked, so auditor needs to, auditor will ask representation from the management. Sometimes management will not have requested information. They will go to the concerned persons in the organization, get the required information and give the written representation to the auditor. Who are that concerned persons with whom management will go and inquire? Examples. Who could be that persons in the organization with whom management will go and consult? Like they have given examples like actuary. You are asking a written representation regarding provision, but management did not create it. Actuary has created it. Then what management should do? Go to the actuary, get the information, and then provide written representation to auditor. Similarly, legal expert, like as I've told, litigations and claims, and also staff engineer. When I'm asking something relating to the plant and machinery or some assets, then also what they can do, they can go to the concerned staff engineer, get the information, and then provide written representation to auditor. Next, when to obtain written representation from management to reconfirm its responsibilities. See, generally what I will do is at the beginning of the audit, at the beginning of the audit only, from the management, I will take written representation regarding two important things. No, what are they? That the management will fulfill their responsibilities regarding preparation of financial statements and completeness of information provided to auditor. At the beginning, I will get that written representation. But sometime during the course of the audit, I need to get once again written representation from the management to reconfirm their responsibilities. I got written representation at the beginning. They have confirmed their responsibilities. But in some cases, during the course of the audit, I need to get a confirmation once again that they are reconfirming their responsibilities. When? Number one, those who signed the engagement letter have changed. Initially, when you have accepted the audit, there were separate people who have signed the engagement letter. Now different people are there. Might be management has undergone some changes. Or terms of engagement are prepared in the previous year. Basically, last year you have got the written representation. When in the current year, see, some matters you need not obtain written representation year after year. You can use the last year's written representation also. But in case if the terms of the engagement have changed, then what we will do in the current year, we will get once again written representation. Or management misunderstands its responsibilities. Initially, when I asked for confirmation, management gave written representation, but they were confused. They did not understand it properly, and they gave the confirmation. I got to know about it. Let us sort out the misunderstanding by getting once again a written representation, and also if there are any changes in the circumstances. So these are the cases where the auditor will try to get written representation once again from the management to reconfirm their responsibilities. Next one. Sometimes you will get the written representation. You will ask the written representation. Management has given you that written representation also, but you have a doubt that those written representations are not reliable. When you will generally have a doubt that written representations are not reliable, when you have a doubt regarding their integrity, when you came to know that they are not honest people, or when you came to know that they are not having competence, they don't know what is exactly happening in the organization, but still they have given written representation, or you came to know that they don't have ethical requirements, they don't follow ethics and all, they're all fraudulent peoples, then generally you should get a doubt that whatever written representations you have got, they are not reliable. And also, you should get a doubt that written representations are not reliable when they are inconsistent with other evidences. I told written representation is just a supporting evidence. So you would try to generally match that evidences with written representation. Sometimes they might be mismatch. I got evidence something else, management is confirming something else. Then what I should do? Then what I should do is I should try to resolve it. Where is wrong? Is my evidence wrong, or management is only giving written representation? If I decided that, okay, my evidence is only wrong, I will perform extra procedures and get the correct evidence. If I came to know that written representation itself is wrong, management has given written representation itself as wrong, is that a small issue or big issue? Very big issue. Management knowingly they have provided you wrong information. Now they say that in those cases you should take extreme action. You can even go and give a disclaimer of opinion. What you can give? Disclaimer. Why disclaimer? If the management has given the written representation itself wrong, what is the guarantee? Whatever information they have provided you, whatever financial statements they have given to you, to what extent they are genuine? Do you have any clarity? No. So that's why it is completely a deadlock situation. So what they have told us, in those cases, you can even go to an extreme and give a disclaimer of opinion. Next. Sometimes management will not give written representations only. I'm asking for written representation, sir. I want some matters for you to confirm. Please confirm. But the management is not at all giving written representation. Previous paragraph, I asked for written representation. They have given it, but those are not reliable. But now what? I asked for written representation. They are not at all giving that written representations only. Then what I should do? First, I should go and discuss. Be a gentleman once again. Go and discuss with the management. Sir, why are you not giving me written representation? Then if they give it, well and good, fine. If they are not giving, even after discussion also, they are not giving that written representation, then what we should do is re-evaluate the integrity of the management. Once again, now you got to know about the true nature of the management. Earlier, when you initially did the risk assessment, you thought that management are honest, but now you have realized that the management are not honest. Here also you need to consider modifying the opinion. Here also what you can do is go to an extreme and give a disclaimer of opinion. Why? Because management themselves are honest. To what extent I can rely whatever information they have provided to me till now. Understood? Comfortable, everyone? So this is what regarding SA 580. So we have completed SA 580 also. Now we will do one more thing. SA 510 we will try to cover. After that we'll go for a break. Right. So let us try to do SA 510, which is talking about initial audit engagement and opening balances. Before we go deeper, what does the standard say? First, let us become familiar with what is the meaning of initial audit engagement, what is the meaning of opening balances. The initial audit engagement I have already told. Initial audit engagement I have already told. If the previous year auditor and current year auditor are different, if the current year auditor is different from previous year's auditor, then the current year engagement will become initial audit engagement. This in simple terms. But how they have defined this term initial audit engagement in SA 510 is the engagement in which either prior years were unaudited, last year is not at all audited, or prior years were audited but by a predecessor auditor, someone else, not your firm. Someone else has conducted the audit of the previous year. Then also in the current year it will become initial audit engagement. So either prior years were unaudited, or the current year auditor is different, or the prior year is audited by predecessor auditor. Then what is the meaning of opening balances? You all know it, no? What is the meaning of opening balances? Those balances which are there at the beginning of the year. Those are nothing but last year's closing balances. And when I say balances, once again you will look at only balance sheet. But when I say opening balances, it even includes the disclosures also. Might be in the last year's balance sheet, in the last year's notes to account, they have told there is a contingent liability. Even that will also become an opening balance. So when I say opening balance, don't restrict yourself to balance sheet. Even in notes to accounts also, whatever things are there, they might also fall under opening balances. Then what is the auditor's responsibility? And one more thing before that, we say opening balances reflect two things. Opening balances reflect two things. What information is reflected in the opening balances? Number one, opening balances reflect the effect of all the transactions whatever have taken place in the preceding financial year. And also opening balances reflect accounting policies which are followed in the previous financial year. So opening balances reflect two kinds of information. So what will they reflect? Number one, they reflect the effect of all the transactions which have taken place in the previous year. They also reflect accounting policies which have been followed in the previous financial year. And when I say accounting policies, one fundamental accounting assumption should come to your mind: consistency. So by checking opening balances, you will get to know what accounting policies are followed in the previous year. Now you need to check whether the same accounting policies are applied in the current year. If they have changed, is there a proper disclosure there or not? So the same thing they will try to say there in the objectives also. What this standard is expecting from the auditor is they are expecting from you two things. Number one, obtain sufficient and appropriate audit evidence. whether opening balances contain a material misstatement that could affect the current period financial statements. Definitely, when the opening balances contain a misstatement, that is obviously going to come and affect my closing balances also. So that's why you need to obtain sufficient and appropriate audit evidence whether opening balances contain a misstatement that could affect my current period's financial statements. You need to obtain evidence regarding that. Sir, how I can obtain audit evidence? By performing audit procedure. Second objective, we will come to that later. First, let us complete the discussion regarding first objective. So you need to obtain audit evidence whether opening balances contain a misstatement that affect my current period financial statements. But in order to obtain sufficient and appropriate audit evidence, I know that I need to perform audit procedures. Sir, what audit procedures I have to perform to obtain audit evidence? That also they have told it in the question. That also they have told it in the standard itself. So what audit procedures they have told us? Read the most recent financial statements. Whatever most recent financial statements are there, that you have to read and determine whether prior period closing balances were correctly brought forward. Nothing but last year closing balances are matching with current year's opening balances or not. You have to check. Any adjustment relating to prior periods have been shown as prior period items. In the current year, if you find any error which belongs to a previous year, that you have to show it as a prior period item in the current year. So that you need to check. And also whether opening balances reflect application of appropriate accounting policies. Whatever accounting policies that are reflected in the opening balances, are they appropriate? Basically, whether correct accounting policies they have followed or not. And even you need to perform specific audit procedures like comparing the opening trial balance with the last year's audited financial statements. In addition to that, in the standard, you will be able to find something else. They specifically talk about what audit procedures you need to perform regarding current assets and liabilities, what audit procedures you need to perform regarding non-current assets and liabilities. That also they try to add it here. Just go through it once. Okay, so they don't go that deeper. Just if we understand this broader audit procedures, that will be enough. So this the later thing you can go, or once again, if you want me to quickly take you through it, I will take you through it. So when it comes to current assets and liabilities, what you should do? So in the case of inventories, if you just the current period's audit procedures on the closing inventory balances provide little audit evidence regarding inventory on hand at the beginning. See, in the current year, you will do closing balances verification, closing inventory verification you will do. That will provide very little evidence regarding opening balances. So when you are doing physical verification for closing balance, you get evidence regarding current year. From that, you will not get any evidence regarding opening balances. Therefore, additional audit procedures may be necessary. That's why in order to obtain evidence regarding opening balance of inventory, you need to perform additional procedures in addition to current year's inventory. So what I need to perform? Number one, observe a current physical inventory counting and reconciling it with inventory quantities. Nothing but if you are satisfied with the current year's closing stock, if you could do reverse calculation, like same like we have done in the SA 501, if you are satisfied, if you are satisfied with current year's closing stock, you have to do reverse calculation and find out opening balance. That opening balance should match with my last year's closing balances. That you can do. Or you can perform audit procedures on the valuation of the opening inventory item. Nothing but ask the management to share the last year's valuation sheet. Try to perform audit procedures whether they have done the valuation properly or not. And also performing audit procedures on gross profit and cutoff, basically analytical procedures. These are nothing but analytical procedures you need to perform. Gross profit margins and all you have to compare. So this is what specifically you need to do regarding current assets and liabilities. And for non-current assets and liabilities, what you should do is like property, plant and equipment, investments, long-term debt. So you can obtain audit evidence by verifying accounting records and other information. Like for example, if PPE is there, management is saying this PPE is there in the as a part of opening balance also. What you can do is you can ask the management to share the copy of the ownership deed. In the ownership deed, I will see when is the date of the purchase. So that will give me evidence whether this is only belonging to current year or this belongs to previous year also. Next, in certain cases, the auditor may be able to obtain some evidence regarding opening balances through confirmation with third parties. Even external confirmations also you can use. So whatever it is, you perform audit procedures. These are general audit procedures, and we have seen specific audit procedures for current assets and liabilities, specific audit procedures for non-current assets and liabilities. So perform all these audit procedures and obtain audit evidence that opening balances do not contain any material misstatement. Okay, now after performing that audit procedures, what will happen? You came to know that opening balances do not contain any kind of material misstatement. What you will do? Unmodified opinion you will give. On the other hand, if you obtain sufficient and appropriate audit evidence that opening balances contain a material misstatement. You performed all the audit procedures, whatever we have told you till now, and you concluded that opening balances contain a material misstatement. Then what you will do? Then you have to modify. Which modification? Either a qualified or adverse. If it is only material but not pervasive, qualified. If it is material and also pervasive, adverse. What will be the other case? You already know. You are unable to obtain sufficient and appropriate audit evidence to determine whether opening balances contain a material misstatement or not. Then what you should do? Either you should give a qualified opinion or disclaim, depending on whether a possible effect is being material or material and pervasive. Understood? Next. So one objective only we are done. Till now what we have done? One objective. But I told there are two objectives. What is the second objective? As I have told, opening balances are reflecting accounting policies. But regarding accounting policy, we have a fundamental accounting principle, which is consistency. So they say you need to obtain sufficient and appropriate audit evidence whether accounting policies which are reflected in the opening balances, they have been consistently applied in the current year. Or if at all they have changed, that change has been properly disclosed or not. If there is a valid reason, you can change the accounting policy, but you have to give a proper disclosure. What change you have made, because of what is the effect, sometimes retrospective effect, sometimes prospective effect. All this you have learned in the accounting standards. That proper disclosure is required to be given. So I need to obtain sufficient and appropriate audit evidence. Without any valid reason, they should not change accounting policy. Point number one. If there is a valid reason, they can change it, but it should be appropriately disclosed. Now, how it will have an impact on opinion? Number one. So there could be two cases. Listen carefully. Management, if you have obtained sufficient and appropriate audit evidence, management, without any valid reason, they have changed the accounting policy. That means consistency has been violated. The management has changed the accounting policy without any valid reason. Or there is a valid reason. That's why management changed the accounting policy, but they did not give proper disclosure. Two cases. You have an audit evidence where without any valid reason, management changed the accounting policy. Or you have evidence that management has changed the accounting policy. There is a valid reason, but they did not appropriately disclose it. In both these cases, what you are supposed to do? Modified opinion you have to give. Which kind of modification? I told you have a evidence. What you will do? Either a qualified opinion or adverse opinion you are required to give. Here the standard did not say what if there is no audit evidence. For opening balances, they have told two cases. You have evidence, you don't have evidence. But for accounting policies, they talked about only one scenario. What is that? If you have evidence, then you give either qualified or adverse. They did not say about no evidence. See, in accounting policies, you cannot say I don't have evidence. You are an expert. No. What are you? Expert. Expert in what? Accounts and audit. You can't go and say I'm unable to decide whether the accounting policy is consistently applied or not. I'm unable to decide whether the disclosure has been given or not. Can you say that? If you say that, will that be a shame on you or not? If I say keeps it in the material, if it is more shame or not. So that's why they did not give that scenario. So when it comes to accounting policies, only one scenario. You will have evidence. You must have the evidence. Then only you deserve to be a chartered accountant. So you will have evidence, you must have evidence whether accounting policies are consistently applied, or if there is any valid reason for change, whether it has been appropriately disclosed or not. So then you will give qualified or adverse. Then one more last paragraph. Sir, I am doing the audit for the current year. Last year auditor has given a modified opinion. Is there a mandatory obligation on the current year auditor to also give the modified opinion? If such mandatory obligation is there, once the company gets a modified opinion, never back in its life, they will get again a unmodified opinion. So it is not the case. Just because last year's auditor's report contains a modified opinion, the current year auditor need not always give a modified opinion. He will give modified opinion in the current year only when that matter still remains relevant and material for the current year, and it is not rectified in the current year. Then only he will express what? Modified opinion. If because of whatever reason last year auditor gave modified opinion, that is no longer relevant for the current year, that is no longer material for the current year, if it has been rectified in the current year, then there is no need for giving modified opinion. You can give unmodified opinion. Understood? That's all. This is what regarding SA 510. How many standards we have covered? 4 we have covered. 501, 505, 580, 510 we have. How many more we have under 500 series? 550 we have, 560 we have, 570 we have, Five, that only 580 we have covered. 3 we have 520, 530 we will have a separate discussion. Okay, with that 500 series will get over. Then we have 200 series, 260, 265 that we will try to cover. After that we have 450 evaluation of misstatements that is getting asked very frequently in the recent because it was a newly added content. So then we will do 260, 265. After that, that 450 also we will do evaluation of identified misstatements we will do. Then after that, SQC1, SA220. SQC1 and SA220 also we will do. Then apart from that, SA620 we will do. Quickly SA620 using the work of internal auditors we will do. Sorry. 610 using the work of internal auditor we will do quickly. 720 I will not explain. 720 I will not do is that standard is not at all fit for revision, but still on my YouTube channel you will be able to find a detailed video with the charts. I have chat and the detailed explanation of that. Sorry. Yesterday I worked on 620 and 720 for CFN, so that thing is only coming on my mind. So 7 comparative information and all that standard is there. So that for that I have a chart. Detailed explanation has also been there. A video we will be able to find in the YouTube that you can watch. Perfect clarity you will get. I know SS710 is troubling for many, but just to watch that video, your perspective will change regarding SS710. Such an easy standard it is. So just go and watch that video. After that, I will wind up standards. We will wind up the standards and we'll see after that what we will do. Okay. We will do. Now, if I start asking your opinions, everybody will say one chapter. So it becomes quite difficult. We will see, depending on the availability of the time and all. We will try to cover. I think I can easily cover audit in an automated environment, audit sampling, and analytical procedures. These 3 chapters, just like that, I can complete it. After that, also, if the time is left, we will see. Okay. Strategy planning and program also we will do. There also questions are getting tested. We will do definitely strategy planning and program also we will do. Till now we have completed 4 500 series of the standards. What are they? What and all we have done? 500 we are done. 501 we are done. 505, 510, 580. Yeah. So these 4 standards we have completed. Let us now try to proceed further and understand few more 500 series of the standards. Volume, reduce. Okay. They're doing it. Okay. So first what we will do, we'll take one simple standard, let's say 550, we will try to understand, which is increase. Fine enough? Okay. So now we will try to understand SA 550, which is going to talk about related parties. So as we all are aware, wherever we have a related party transaction, there the risk of happening of material misstatement is very, very high. And also, if you remember, when we discussed the inherent limitation concept, there we have seen one of the main reason for inherent limitation is related party transaction. So that's why wherever related party transactions are there, since there is a huge scope for manipulation, that's why accounting standards also have a lot of disclosure requirements. So many disclosure requirements are there regarding related party transactions, even as per accounting standards. Similarly, from auditing perspective also, since related party transactions have a high chances of misstatement, they have given us a dedicated standard. It exclusively gives us a guidance what audit procedures you need to perform, what evidence you are required to obtain regarding related party transactions. But before that, we need to understand what is the definition of related party. Now, here the standard has played it very safe. They have told that in the applicable financial reporting framework, if the related party has already been defined, follow that definition. Like for example, if you take companies, in case of companies, applicable financial reporting framework is Schedule 3 and accounting standards. In case in that applicable financial reporting framework, if the related party term is already defined, follow the same definition. Whatever definition they have given under applicable financial reporting framework, whoever they told will fall under related party definition. So just follow the same definition. In case applicable financial reporting framework does not define the term related party, then follow the definition whatever we are giving in the standard. If applicable financial reporting framework defines, follow the definition. In case if the applicable financial reporting framework doesn't define the term related party, then in SA 550 they have given the definition. That definition you are supposed to follow. Sir, as per the definition of SA 550, when 2 parties will be considered as related? So they say that 2 entities will be considered as related if they have control or significant influence over entity. If a person is having control over another entity or influence over another entity, so that then both will become related parties. Or another entity over which reporting entity has significant control or influence. You are controlling someone or someone is controlling you. You are having significant influence on someone or someone is having a significant influence on you, related parties. And they say one more thing also, another entity that is under common control with the reporting entity, either through common ownership, owners who are close family members, or common key management. Basically you and some other entity, your client entity and some other entity, both are under common ownership. A third party is controlling both. So then these two entities which are under common control, they will also become related, and that common control can be by way of common ownership, or the owners can be close family members, and even they could be a common key management. So someone is having, if someone is having influence over your client, related party. Your client is having influence or control on other, related party. Your client and some other entity both are under common control of some third party, then that entity which is with common ownership under you, common control under you, so that also will become a related party. Clear? Next. And here there is one exception. They have given an exception regarding government entities, state related entities. So they say that entities which are under common control by a state, even though they are under common control, they will not be considered related unless they engage in significant transactions or share resources. So I told that which are under common control. If two entities are under common control, they will be considered as related. One exception to that rule. If two entities are under common control of a state in the sense government they are talking here. If two entities are under common control of a state, they will not be considered related unless they share resources or unless they engage in significant transactions. So this is how the term related party has been defined. Then talking about the nature of the related party transactions. See, related party transactions, if they are happening like a normal transaction, under whatever terms and conditions normal transactions happen, under the same terms and conditions, if the related party transactions are also happening, be it price, be it payment terms, be it delivery terms, whatever it is. So if the related party transaction is also happening at par with a normal transaction, then there will be no high risk of material misstatement. Then they will be having low risk only when they are equal, in all terms. So if the related party transactions are in the normal course of business, then there might be no higher risk of material misstatement. But however, in some cases, the risk is very, very high. In some cases, related party transactions carry a very high amount of risk. In what kind of circumstances? Number one, if they operate through extensive and complex relationship. There is existing on related party through with which you don't have any direct relationship, but the relationship is very complex. So what do you mean by indirect relationship or complex relationship? Is, say for example, there is one company. It has created one subsidiary. That subsidiary created one associate. That associate is having some joint venture. In that joint venture, one director is there. That director has incorporated another company. So a very distant change is there. Very complex relationship is there. In these kind of cases, it becomes difficult for you to identify whether that entity is a related party itself or not. So whenever the related parties are operating through extensive or complex relationships, it becomes very difficult, that the risk of material misstatement is very, very high. On the other hand, if the relationship with the related party is straightforward, like direct subsidiary company, direct associate company, direct joint venture, then it is low risk. But if it is a complex or extensive relationship, then there is high risk. Similarly, information system may be ineffective. Whatever information system, basically today, so many related party transactions will be there. And if you open the financial statements of any company, related party transactions, so many pages of disclosures will be there. 2-3 pages will be dedicated only for explaining related party relationships and related party transactions. Today, the human beings are not accumulating all the related party transactions. The accounting software itself will identify the related party. That accounting software itself will accumulate related party transactions. That software will itself give a report. So now what we need to check is whatever that software they are using, whatever accounting software they are using, is it effective or not? Why? Because if the accounting software is effective, if the accounting software has been designed properly, yes, related party disclosures will be given appropriately. On the other hand, if the client is using some useless information system, if it is not able to identify or accumulate all the related party transactions, and if the company starts relying on such a software, the system will give wrong reports. That reports only they will include in the financial statements. In those cases, financial statements are having a chance of misstatement or not. Yes, that the risk is very high. Similarly, when the related party transactions are not conducted under normal market terms and conditions. like pricing is different, you are showing some favorism to your related parties, there the risk of material misstatement becomes very high. So summary of this paragraph is, generally if the related party transactions are happening under normal market terms and conditions in the normal course of business, they might not carry higher risk, but in some cases there will be a very high risk of material misstatement with regard to related party transactions. Three cases they have given where there will be high risk of material misstatement. What are they? When they operate through extensive and complex relationships, information systems may be ineffective, and they are not operating under normal market terms and conditions. Next. So what will be the responsibilities of an auditor? As an auditor, if you came to know that your client is having related party relationships or related party transactions, as an auditor, what responsibilities you are required to fulfill? Number one, first you have to obtain audit evidence regarding accounting and disclosure requirements. Basically, as I have told, even if you take Schedule 3, even if you take accounting standards, there are so many disclosure requirements they have mentioned. So as an auditor, my objective is to obtain sufficient and appropriate audit evidence, whatever accounting and disclosure requirements are given under accounting standards, under applicable financial reporting framework, whether all that accounting and disclosure requirements are fulfilled or not. So what I have to do as an auditor, what is my responsibility? Whatever accounting and disclosure requirements are there given under applicable financial reporting framework, whether the related party transactions are accounted as per that, whether all the disclosures are given as per the applicable financial reporting framework. Now, as we all are aware, if we want to obtain evidence, what we should do? You should perform audit procedures. So to obtain that audit evidence, what audit procedures I have to perform? That they are mentioning in the standard itself. So as an auditor, you should perform audit procedures like you have to obtain an understanding of accounting and disclosure requirements. Common sense, no? Before you can see whether accounting and disclosure requirements are met or not, first you should know what are the accounting and disclosure requirements. So first you should go through the applicable financial reporting framework, and first you understand what are accounting requirements, what are disclosure requirements. Then to obtain understanding of related party relationships and transactions, now go and sit with the management, ask them, give me a list of all the related parties, give me a list of all the transactions you have done with the related parties. Then to conclude whether financial statements give a true and fair view and are not misleading, especially because of related party transactions. So you need to perform audit procedures. Which audit procedures you have to perform? First, obtain an understanding of accounting and disclosure requirements. Number two, obtain an understanding of related party relationships and transactions. Number three, finally obtain an understanding whether financial statements are giving true and fair view and they are not misleading, especially because of related party transactions. Next, see, because of related party, the chances of happening of fraud are also very high. And once again, if you apply the practicality here, many frauds, whatever have taken place in the recent times, in every fraud, you will be able to find the related parties. They commit this fraud through shell companies. They incorporate this subsidiaries, associates, like shell companies, we call them, just for namesake, they incorporate the companies, and they incorporate these companies in the tax havens, in the Mauritius or in that British Islands, like that. So we have so many these kind of things are there, tax havens are there, there they will incorporate some related parties, and through the related parties many of the scam funds will go out of India. So related party transactions can lead to high chances of happening of fraud. So that's why you need to pay close attention to the related party transactions to identify whether there is any fraud getting committed. Misstatement, that too because of fraud. The chances are very high. So you need to pay close attention. Then, as we have already seen, because of related party transactions, there is a chance of inherent limitation. One of the main inherent limitation is arising because of related party transactions. So in case of related parties, the significance of inherent limitations are very much higher. Because of related party transactions, the chances of auditor's opinion going wrong are much high. So that's why what you should do is management may be, why? Because management may become unaware of existence of related party transactions. Sometimes management itself will not know who is a related party, who is not a related party. And also related party transactions provide a greater opportunity for collusion and manipulation. So that's why the inherent limitations are very greater for related party transactions. Then you have to maintain professional skepticism. If you want to overcome all these problems, all these headaches, one thing what you can do is you have to maintain professional skepticism. You have to maintain that attitude of questioning mind. To some extent you can reduce your risk. So when we talk about auditors' responsibilities, they have told four things. Number one, you need to obtain audit evidence regarding accounting and disclosure requirements. To do that, first you should obtain understanding of accounting and disclosure requirements. You should obtain understanding of related party relationships and transactions, and also you should make sure that financial statements give a true and fair view and are not misleading. Number two, you should pay close attention for identification of any fraud, because fraud risk factors will be there. Number three, because of related party transactions, the inherent limitations are very higher. Because sometimes management themselves are not aware who is a related party, and also related party transactions provide greater opportunity for collusion. And then finally, last one, you have to maintain professional skepticism. If you have to overcome these problems, you have to maintain professional skepticism. And also we have one more last thing, how auditor can verify existence of related parties. If you want to know whether your client is having related parties or not, what you should do? First, you should go and ask the management. You will go and ask the management, sir, please tell us who and all are your related parties. You will do inquiry. But in case of inquiries, I have already told you, inquiry will give least evidence. If you go and ask to the management, sir, I want you to give me a list of all the related parties, they will give. But you should not blindly believe on that. You should also verify some documents from your side to know whether related parties are there or not, or management has hidden some related parties from you. You will definitely go and ask. Management will give a list, but you don't blindly rely on it. You also try to verify some documents from your side to identify the related parties. So what documents I have to verify, sir, to know whether there is any existence of related parties? Number one, you can go through income tax returns. There also they will report related party transactions, and also information provided to regulatory authorities. Like in case of MCA, company filings and all, you are required to file the details of related parties. You can go through that filings also. Shareholders register. If you go to shareholders register, you will come to know who is your holding company, who is your associate entity, that you will get to know. Then statement of conflict. Basically, statement of conflict is a thing under Companies Act where they say if you are a part of the management and if your company is going to take decision in which in the transaction you are having interest. Like for example, there is a person, Mr. A. Now this person A is a director in the company ABC Limited. This ABC Limited wants to purchase goods from a firm XYZ and Co. A firm is there. From that firm they want to purchase the goods. But in that firm, one of the partner is Mr. A once again. So this company is doing a transaction with another entity, but in this transaction, one of the director is having a interest. So when they are doing that decision making, they should stay away from that decision making. Here in this transaction, Mr. A should stay away. Why? Because he is having a interest there. And he should submit something called conflict of interest to the management. In listed companies and all, it will happen. So they have to submit a statement of conflict. They will say, boss, the company or the entity with which you are doing the transaction, in that I am having a interest. So like that, they will submit a statement of conflict. Now, one simple logic, if I can go through that statement of conflict, I can easily understand who is a related party, who is not a related party. And also I can go through investment register. If you go through investment register, once again, you will get to know subsidiary companies, associate companies, joint ventures, that you will get to know. Contract and agreements with the management. So nothing but with the key management, what and all contracts you have entered, go through that contracts and agreements. And contracts which are not in the ordinary course of business. If you find any contract which is beyond the normal course of business, try to dig deeper. Why? Because outside the normal course of business, the companies do transactions only with the related parties in 99% of the cases. And then even you can go through internal auditors report. So definitely you will inquire for related parties, but don't just stop with inquiry. You verify the documents, you verify these documents from your side, so that you might find the existence of a related party. Understood? That's all. We have completed SA 550. Related party discussion, we are done. So now what we will try to do is, we will pick the next most important standard, 570 we will pick now. What? Go, oh, title you are telling, fine. Okay, so we will try to cover now SA 570, talking about going concern, one of the most important standard from the examination perspective. Conceptually also it is very important. So let us try to understand SA 570, which is talking about going concern. Is going concern an important matter? Is going concern is important in the preparation of financial statements? And even if you are aware, they say going concern is a fundamental accounting assumption. What is it? Fundamental accounting assumption. What do you mean by going concern? First of all, the entity will continue for the foreseeable future. Foreseeable future means how long? 1 year. For the coming 1 year, entity will continue. Neither it is having a intention to liquidate, nor there is any pressure on them to liquidate. So just having an intention alone will not be enough. If the management says, yes, we have an intention to continue in the coming 1 year, will going concern be valid? No, situations also should permit them. Their financial position should permit them. Sure, their operations should permit them. So there is no intention and also there is no requirement for the entity to close down in the foreseeable future. That assumption, we call it as going concern assumption. Now, so what role going concern assumption plays? How it is going to have an impact on the financial statements? How it is going to have an impact on the financial statements is, see, when I prepare the balance sheet, when the management prepares the balance sheet, as on the date of the balance sheet, they have to make one decision whether going concern is valid or not. They have to make an assessment and determine it. If they feel that going concern assumption is appropriate, that means entity will continue for the foreseeable future. Then they will prepare the financial statements on that basis. On going concern basis, they will prepare financial statements. So what do you mean by preparation of financial statements on going concern basis? So basically what they will try to do is fixed assets they will value at the historical cost. So current assets they will value at the realizable values and all. So historical cost we follow for fixed assets, mainly fixed assets. That is where the impact is going to come. So mainly fixed assets will be valued at historical cost. That means whatever you have acquired it at a long ago, so at that price we will value it. Why? Because fixed assets we are not holding with the intention of selling. So we are holding it for the purpose of using it for our business. So that is what the meaning of going concern basis. So when we are preparing the financial statements on going concern basis, we continue to value our fixed assets at historical cost because we don't have any intention of selling them. In case if the going concern assumption is invalid, if the going concern assumption is invalid, what do you mean by going concern becoming invalid? The entity will not continue for the foreseeable future. Either the management wants to liquidate or the situations doesn't permit the entity to continue for the foreseeable future. Then the company can no longer value their fixed assets at historical cost. Because if entity will not continue for the foreseeable future, even fixed assets are held with the intention of selling. So in that case, we prepare financial statements on something called liquidation basis, we say. What do we say? Liquidation basis. That means all the assets, all the liabilities, we will determine if the company sells them as on the balance sheet date, how much they will be able to realize. That value they will determine. All the assets, all the liabilities will be shown at realizable value. And the difference between that book value and the realizable value, that will go and give the impact to the statement of P&L. So you tell me, going concern is having a significant impact on the financial statements? Very bigger impact on the financial statements it is going to have. And in case if the management tries to tamper with the going concern assumption, the management tries to do wrong things regarding going concern assumption, will it be a misstatement in the financial statements? Yes. Will it be a material misstatement? Will it be a pervasive misstatement? 100% yes. Why? Because going concern is something which is fundamental to users' understanding of the financial statements. Okay, so till now we understood the importance of going concern assumption from the accounting perspective. Now, as we all are aware, standards on audit doesn't talk about financial statements. Standards on audit talk about auditing requirements. So now, as an auditor, what is your responsibility? As an auditor, what is your responsibility? First of all, who will make an assessment regarding going concern? So whether we will continue for the coming 1 year or we will not continue for the coming 1 year, whether going concern assumption is valid or invalid, who will do that assessment? It is always and always the responsibility of the management to do the assessment. On what basis they will do the assessment? Will they toss a coin? Heads comes going concern valid, tails comes going concern invalid? No. So they will consider some factors. So what factors they will consider? They will consider the factors like size and complexity of the entity. What is the size of the entity? What is the complexity of the business they are doing? And also they focus on nature and condition of the business. What is the current nature of the business? What is the current condition of the business? They will pay attention. Uncertainty of events and conditions. Like for example, any legal cases going on them, any significant changes in the laws and regulations are going to come. So they will even pay attention to events, uncertain events like pending cases, laws and regulations. And even they will consider the effect of external factors. Once again, this laws and regulations kind of thing. So they will pay attention to various factors. These all factors they will consider, and then they will make an assessment whether going concern assumption is valid for them or going concern assumption is invalid for them. Now, what is auditor's responsibility? Till now, we have seen management responsibility. What is auditor's responsibility? To obtain sufficient and appropriate audit evidence whether whatever management has done the assessment regarding going concern, is it valid or not? Is it appropriate or not? whatever assessment management has done regarding going concern, whether that assessment of going concern done by the management is appropriate or not, that we need to obtain sufficient and appropriate audit evidence. Like if the management says yes, our going concern assumption is valid, we will continue for the foreseeable future, they are preparing the financial statements on going concern basis, they are continuing to value the fixed assets on historical cost, now I need to obtain audit evidence. Is it so really the entity will continue for the foreseeable future, or there is any requirement on the company to close down in the coming 1 year? That appropriateness, regarding that appropriateness, I need to obtain sufficient and appropriate audit evidence. So obtaining audit evidence is my responsibility. So I will come back to this remaining two responsibilities later. I will come back to this two responsibilities later. So now, okay, so your objective is to obtain what? Sufficient and appropriate audit evidence. Now, to obtain that sufficient and appropriate audit evidence, you need to perform audit procedures. So what audit procedures and all you will perform, we will talk about it later. But after performing all the audit procedures, what audit procedures we will do, we will discuss it. But after performing all the audit procedures, he will be left with some observations. He will have his findings. Now let us try to understand what impact that findings will have on his opinion. What impact that findings will have on his opinion. So I will do some different this chart only. This is a since it is getting very clumsy, I have divided the chart into multiple parts. But if I draw one single chart covering all, so after he has done all the audit procedures, there might be multiple cases. Let us try to understand each case. Number one, you performed audit procedures, you obtained assumptions, you obtained audit evidences, and you have concluded that the management going concern assumption, whatever management has decided, that is appropriate. Or let me put it this way, going concern assumption is valid. Entity will continue for the foreseeable future. There is no doubt, there is no intention also, there is no requirement also to close down the business. Entity will definitely continue for coming 1 year. You have perfect evidence. Very good. Management has also prepared the financial statements on going concern basis. Now what you will do? Management has also prepared the financial statements on going concern basis. What you will do? You will give unmodified opinion. So basically we will give what? Unmodified opinion we will give. No issue to modify the opinion. Next. Let us come to the other case. What could be the other cases? You might decide that going concern is invalid. You came to know going concern is invalid. That means entity will not continue for the foreseeable future. Then what we should do? So then we should decide whether there is a adequate disclosure in the financial statements. In case if you came to know that going concern is invalid, we need to check, is there a adequate disclosure? So what do you mean by adequate disclosure? What do you mean by adequate disclosure? So adequate disclosure in the sense that the company has realized that fact that going concern assumption is invalid and have prepared the financial statements on liquidation basis, and the differential component they have taken into the statement of P&L. So everything they have valued at realizable value, difference also they have taken to the statement of P&L. In the notes to account also clearly they have explained that they will not continue for the coming 1 year. What opinion I will give here? Unmodified opinion I have to give. Why? Because I will give modified opinion only when there is a material misstatement. But here people are genuine, no. So they did not hide anything. Yes, they also agreed, yes sir, we will not continue for the coming 1 year. They agreed to that fact. They have valued all their assets and liabilities at realizable value. Differential also they have taken to statement of P&L. Even in the notes to accounts also they have clearly explained that they will not continue for the foreseeable future. So no mistake they have done. So here there is no purpose in giving a modified opinion. What I can do here? Unmodified opinion I will give. What if there is no adequate disclosure? What if there is no adequate disclosure? What do you mean by not giving an adequate disclosure? Even though I got to know, even though I have a clear evidence that entity will not continue for the coming 1 year, but management is denying the fact and they continue to prepare the financial statements on going concern basis only. That means they are still continuing to value their fixed assets on historical cost basis only. Now what I should do? Now you have to modify. Which kind of modification? So you have to directly give a adverse opinion. Directly give adverse opinion you are supposed to give. Okay, why adverse? So as we have told at the beginning, if the management tries to tamper with the going concern assumption, definitely that will lead to a misstatement. That misstatement will not just be material, it will be pervasive also. And you have a evidence that going concern is invalid also. So you are supposed to give adverse opinion. Understood till here? Next. Let us come to one more case. So what is the one more cases? You performed audit procedures. You came to know that going concern looks valid only, but there is some material uncertainty relating to going concern. For the time being now, going concern looks valid, but there is some material uncertainty relating to going concern. There is some uncertainty, there is some doubt. That means whether entity will continue in the future or not, some doubt is there. For the time being now looks good, but it is depending on some events. If I put it in this way, it depending on some events whether entity will continue in the future or not. That is going to depend on some events that is even beyond the control of the auditor, beyond the control of the management. So if I have to give you one example, your client company is going through some pending case. Your client company is going through some pending case. The person, whoever has filed the case, he is demanding a very huge amount of money. As on the balance sheet date, the proceedings are still going on. If that case materializes, just in case, if that case materializes, and if the person who has filed the case, he wins the case and company loses the case, the penalty amount or the consequences which the company has to face are so huge that the entity will not be able to continue. The entity will not be able to continue if the company loses the case. Able to understand? I'm not telling company will definitely close down. What I'm saying, company might get closed down if it loses the case which is currently going on in the court. So here there is an uncertainty. Because of some circumstances, I'm unable to decide whether entity will continue in the future or not. I have a uncertainty. I performed audit procedures. I came to know there is a material uncertainty relating to going concern. That is depending on some events or conditions which are beyond the control of the management, beyond the control of the auditor and all. Now what you should do? Now what you should do? If you found material uncertainty relating to going concern, what you are supposed to do? So here also, if you found material uncertainty relating to going concern, you need to check whether there is a adequate disclosure or is there no adequate disclosure. If there is a adequate disclosure, what you will do? Had the management made any mistake? Are the financial statements misleading? Are the financial statements giving true and fair view there? Yes, 100% yes. So what opinion you will give? Here also I will give unmodified opinion. But see, management without their fault, they have already disclosed or presented an information in the financial statements. But don't you think this is very fundamental to users' understanding of the financial statements? The management without their fault, they have appropriately disclosed and presented this information in the financial statements. Don't you think, even though they have disclosed and presented it, it is a matter which is very fundamental to users' understanding of the financial statements? So, don't you think the auditor is having a need to highlight this somewhere in the auditor's report? What he can do? Not keyword. Emphasis of matter paragraph. The matter which is already presented or disclosed in the financial statements, but it is very fundamental to users' understanding of the financial statements, that is required to be highlighted in emphasis. You could have done it if the standard has not told anything specifically. The standard has not told anything specifically. As you said, what we would have done is we would have highlighted that in the emphasis of matter paragraph. What the standard specifically says here is you highlight it, but don't use emphasis of matter paragraph. You use a separate paragraph with a title material uncertainty relating to going concern. You highlight it. We don't have any objection. You highlight it. But don't use the emphasis of matter paragraph. You use a separate paragraph with a heading material uncertainty relating to going concern. With that heading, you use that paragraph, then highlight that matter. Understood? Clear and comfortable, everybody? Right. Next, what if there is no adequate disclosure? See, if you remember, we have covered all the contents of the SA 700 except one content I did not explain there, material uncertainty relating to going concern. That content we have covered it here. All the contents of the audit report in SA 700 we are done. One we did not cover, that is material uncertainty relating to going concern, which we told we will talk about in the SA 517. Now we have covered that point also. With this, all the contents of the audit report we have covered. Now, if you come to the other case, if the management is not giving adequate disclosure, then what you should do? So then we have to give modified opinion. Which kind of modification? Which kind of modification? You have to give either a qualified opinion or you have to give a adverse opinion. Now multiple doubts will be there in the minds of the students. Now you will say, sir, since we are unable to determine whether going concern is valid or not, since we are having a material uncertainty, don't you think it is a case of non-availability of audit evidence? So we should have given a qualified or disclaimer of opinion, no, sir. Nobody got that out. We are telling material uncertainty relating to going concern. That means we are unable to decide going concern is valid or not. It is depending on some event. So you should have, it is a case of non-availability of audit evidence, no? Should have given qualified or disclaimer, right? No. Why no is we are modifying the opinion not because of material uncertainty. We are modifying the opinion not because of material uncertainty. We are modifying the opinion because the management did not disclose that material uncertainty regarding which we have evidence. See, if there is a material uncertainty, there is nothing wrong in that. We are not modifying our opinion because there is a material uncertainty. Why we are modifying our opinion? Management did not disclose that material uncertainty. For that I have evidence. No, I clearly know that management did not disclose it. So it is a case of evidence only. I have evidence that management did not disclose that material uncertainty in the financial statements. That's why I will give either qualified or adverse. Now one more doubt you should get. Sir, you told if the management tries to tamper with the going concern and all, it will always be material and pervasive. Directly, you should have told qualified. Directly, you should have given adverse. No, sir. Why once again you are bringing qualified here? Here also, what they say here is yes, if the management tries to do something regarding the going concern, it is definitely material and pervasive. But here, why they have told qualified and adverse is depending on severity of the material uncertainty, we have to decide it. Depending on what? Severity. Say, for example, same, the company is going through one pending case. I spoke with the lawyers of the team and all. I consulted some external lawyer also. Those lawyers are all telling that, sir, company will not lose the case. The company will definitely win the case. 100%, 99% it will win the case. Everybody is saying the company will win the case. There is a material uncertainty. Agreed. But the effect of that uncertainty is not so big. The chances of winning are much high. The chances of going concern becoming invalid are very, very less. So here what I can give? Just qualified opinion I can give. But however, same pending case is going on. The chances of winning or losing I have to decide. Whenever I spoke with anybody, they are saying, no, sir, there is a probability company might lose the case. So here the effect of material uncertainty is very, very bigger. The chances of going concern becoming invalid is very, very higher. Now what I will do? Now I will give adverse opinion. Understood? Clear and comfortable, everybody? So these and all are different outcomes which could be possible. And one more outcome also could be possible. What is that one more outcome is? Management is not sharing their assessment regarding going concern. As an auditor, I need to obtain audit evidence regarding going concern. Management will make an assessment. I will ask them to share the assessment. They will share the assessment. On the basis of that, I will decide whether going concern assumption is valid or not. But when I go to the management and ask, sir, please share your assessment. On what basis you have done the assessment regarding going concern? Please share with that to me. I will do the assessment. I will perform audit procedures and try to obtain audit evidence. Management is telling, no, we will not share that assessment with you. On what basis we have decided going concern is valid or invalid? We will not share that basis only with you. Now, what you will do? Since you are unable to obtain audit evidence, you have to modify your opinion here also, but here you have to give either qualified or disclaimer. But I do personally believe instead of qualified, disclaimer will be the best option. Directly have to give disclaimer, because if the management is not sharing assessment regarding going concern, so maybe here their intention could be majority of the information they have shared just 1-2 points they did not share, then you can think of qualified. But if most of the information is not shared regarding assessment of going concern, then we give disclaimer of opinion. Understood? Clear? So these are all the different outcomes which could be possible and how they could have an impact on the auditor's opinion. Okay, shall we proceed further? Standard over? Not at over. So what we have discussed till now? First we have seen what is management responsibility. We are seeing auditor's responsibility, and that I have told only first point. To obtain sufficient and appropriate audit evidence regarding management's assessment of going concern. Second objective, on the basis of your audit procedures, you have to determine whether there is any material uncertainty relating to going concern. In case if you find any, you have to report as per the standard. How to report as per the standard, that's what we have seen till now in the chart. How to report it, we have seen. Able to understand? So three objectives of the auditor as per SA 570. What are the three objectives? To obtain sufficient and appropriate audit evidence regarding appropriateness of management's use of the going concern assumption. Number two, to determine whether there is a material uncertainty relating to going concern. Number three, to report in accordance with this essay. Okay, next. Okay, so as I was saying, you need to obtain audit evidence regarding appropriateness of management's use of going concern assumption. But to obtain audit evidence, we need to perform audit procedures. So what audit procedures I have to perform? Here also they say I need to perform audit procedures under two categories: risk assessment procedures, further audit procedures. So first, in risk assessment procedures, what we do? No. Risk assessment procedures, what is the outcome? Identify the risk of material misstatement. Like in SA 501, I have told litigations and claims. First, you need to identify whether there is any risk of material misstatement in that area. Here also SA 570 says first perform risk assessment procedures. First identify, is there any risk of material misstatement regarding going concern? But this they phrase it in a different manner. What they're expecting from you is identify whether there is any risk of material misstatement regarding going concern. But they phrase it in a different manner. So what do they say is the auditor shall consider whether any event or condition exists that may cast a significant doubt on entity's ability to continue as a going concern. Find out whether there is any event or whether there is any condition which is creating a doubt regarding entity's ability to continue as a going concern. More or less, if I put it in the other way around, what they are trying to say, find out whether there is any risk of material misstatement regarding going concern. That's what they're actually trying to say. Okay, clear and comfortable, everyone? Right. Next. Yeah. What else we have? How to identify. See, before I can say how to identify, I would like to say one more thing. Before I say how to identify that event, first we should know what are that events or conditions which create a doubt on going concern. Do you agree with me? See, the standard, they're saying by way of risk assessment procedures, they're asking me to identify whether there is any event or condition that may cast a doubt on entity's ability to continue as a going concern. But before that, I should know what are that events or conditions that create a doubt on going concern. Yes or no? So that we call them as indicators. So that standard itself has given. They did not ask you to go and search what events and conditions will cast a doubt regarding going concern. They told we will only say what kind of events and conditions which create a doubt regarding entity's ability to continue as a going concern. And those are divided into three categories. Those are divided into how many categories? Three categories. Those are financial indicators, operating indicators, other indicators. So a few examples of these indicators are also given here. Examples of the financial indicators: the company is having always a net liability position, borrowings are approaching maturity but they don't have any amount to repay that borrowings, negative cash flows, continuously they are generating negative cash flows, withdrawal of financial support, your creditors, bankers are withdrawing their financial support, or adverse financial ratios, bad financial ratios they are having. Operating indicators like management itself is having an intention to liquidate, they don't want to continue any longer. Loss of key management, key persons in the organization have left. Labor difficulties, the company is unable to find the labor who are ready to work for their factory. Shortage of supplies, whatever raw material they want for the purpose of running their business, that raw material is in huge shortage. Or even successful competitor, all of a sudden a huge successful competitor has come and all your customer base has shifted. Or it could be even other indicators like non-compliances with the laws and regulations. Your client is not complying with laws and regulations. Pending cases, so many pending cases are there against your company. Uninsured catastrophes. Uninsured catastrophes. In the recent times, some catastrophe happened, some calamity happened, some earthquake happened, some fire accident happened, and luckily your client is not having an insurance policy. Right. So he will have to close. Then changes in laws and regulations. So these are all other indicators. Why I was talking about this? From where we have come to here? We are discussing risk assessment procedures. So what you should do is, first you should identify whether any of these events are present. Whether any of this financial indicator, any of this operating indicator, or any of this other indicator is present or not. That we need to find it out. Sir, how can I find it out, sir? How can I find it out? Simply what they say here is by inquiring management. Don't do anything, just go and inquire with the management, sir, whether any of these indicators are present. Okay, so now by inquiring management, two outcomes could be possible. By inquiring management, two outcomes could be possible. What will be the two outcomes? There may be, yes, you have found out some events or conditions which create a doubt regarding going concern. That means any of these indicators you have found. Or there may be a case you did not find any events or conditions which create a doubt regarding going concern. If you don't find any of these events which create a doubt regarding going concern, that's all, your responsibility has come to an end. You aren't supposed to do anything. In case, if you came to know about any of these events or conditions which created a doubt regarding going concern, then you need to perform further audit procedures. Sir, what further audit procedures I have to perform? Right. So see here, what further audit procedures I have to perform. The list is there given here. So the further audit procedures which you are required to perform, or where management has not yet performed an assessment of the entity's ability to continue as a going concern, go and request the management to make its assessment now. The management has not yet done the assessment, go and ask them, sir, why you have not done the assessment? Please do the assessment now. And evaluate management's plans for future action. Sit with them. What are their plans for the future? Check them. Don't just get the plans, check how far they are feasible. The company is telling, sir, we have borrowings. You found that companies approaching borrowings are approaching maturity. They don't have funds to pay. They told that, sir, a banker is ready to give us some amount of loan. Don't just blindly believe. If the banker is ready to give the loan, ask them to do the sanction letter. So try to check how far that plans are feasible. And also ask the entity to prepare a cash flow forecast for the coming 1 year, how the cash flows are going to be. So prepare a forecast and check on whatever data that cash flow forecast is prepared, is it reliable or not? On whatever assumptions that forecast is prepared, or those assumptions are realistic or not. You obtain that evidence and check whether any additional information has become available from the date management made its assessment. Management made the assessment, gave it to you. After that, any significant event has taken place which will create a doubt regarding going concern, analyze it. And also you have to request written representation. And in addition to that, you need to perform additional procedures like analyze the cash flow, profit, and all other relevant forecast. Check the entity's latest available interim financial statements. Go through the terms of the debentures and loan agreements. Read the minutes of the meeting. Go and inquire the entity's legal counsel, and also existence of arrangements, financial arrangements with the banks and all also you have to verify. So finally perform all these further audit procedures. Now you will be left with the findings. What findings? Going concern is valid, invalid, material uncertainty, blah blah blah. All that will be left, and depending on that findings, you have to fulfill your reporting requirements. Understood? So SA 570 we have completed. That's it. Next. Now we will talk about SA 560, which is relating to the concept of subsequent events. Right. So what are these subsequent events? These subsequent events we already know. In the accounting, you might have already learned that subsequent events. So what basically is the meaning of subsequent events as per accounting standards? We will come to the standards on audit later, but as per the accounting standard, what is the meaning of subsequent event? Those events which are occurring between the date of the financial statements and the date of approval of the financial statements, that we call them as subsequent events. And accounting standards divide that subsequent events into two categories. What are they? Adjusting events, non-adjusting events. What we should do to the adjusting events? We have to adjust it to the financial statements. Non-adjusting events, disclosures we have to give. So like this is what they have told it in the accounting standards. And as we all know, accounting standards will talk about accounting requirements, not auditors' responsibilities. Whereas standards on audit talk about auditors' responsibilities. So in case if the auditor came across any subsequent events, what he is supposed to do? We know what is the meaning of subsequent events as per accounting standard, but that is not the meaning of subsequent event as per standards on audit. The term subsequent event has been defined under standards on auditing in a different manner. So what is that meaning of subsequent events? But before we could see that what is the subsequent event, we need to understand few dates. Few dates we have to understand. So what are that dates is, number one, date of financial statements. What do you mean by date of financial statements? The date, the end of the latest period is nothing but 31st of March. In India, that will be 31st of March. So if you take 24-25 financial year, 31st of March of 2025 will be date of financial statements. Date of approval of financial statements. The date on which the recognized authority has accepted the responsibility. Basically, whenever board of directors will sign the financial statements, that is when they have accepted. So say for example, date of approval of the financial statements is 10th of April 2025. Then we have date of auditor's report. What is the date of auditor's report? The date which auditor signs and mentions it on the auditor's report. Say for example 15th of April. And then date the financial statements are issued. What do you mean by that? The date on which the financial statements are made available to third parties apart from management and auditor. Whenever these financial statements are being made available to third parties, that date we call it as date the financial statements are issued. Say for example, these financial statements are issued, audited financial statements are issued on 20th of April. Clear? And basically between the date of approval of the financial statements and the date of auditor's report, which one should be earlier? Date of approval of the financial statements. It could be on the same day also, but the date of approval of the financial statements cannot be later than date of auditor's report. Fine. So we understood all these dates. Now let us try to understand what is the meaning of subsequent events. So SA 560 says that subsequent events are those events which are occurring between the date of financial statements and the date of auditor's report, but the fact which became to auditor's knowledge after the date of auditor's report. Some event has taken place between the date of the financial statements and date of auditor's report, but the auditor came to know about that fact after the date of auditor's report. Then only that event we call them as subsequent events. See, if some event has taken place between, if you go back to this dates only, some event has taken place from between the date of financial statements and the date of auditor's report, but auditor should have known after this. If the auditor has known about this event before the date of auditor's report only, there is no requirement of standard, there is no requirement of any guidance only. Why? Because if you came to know about the event before giving the audit report only, whatever action you want to take, that action you can take it through your auditor's report only. So or no? So why do you need a separate standard for that? Not required. No. So when we need guidance, when the things become complicated, you already gave the audit report, you already signed the audit report, then you got to know about a event, but that event has taken place in the past. So now the need will come. Now you start looking for guidance. Have I got to know about this information at the time when I have given audit report? I would have given a different audit report. So that thought comes to your mind. Now you have to take some action. Now you have to start looking for guidance. So that's why subsequent events are those events which are occurring between the date of financial statements and the date of auditor's report, but the fact came to auditor's knowledge after the date of auditor's report. Clear? Next. Okay, we understood subsequent events. Then yeah, what are the objectives of the auditor? As an auditor, what are your responsibilities? So you need to understand, you need to update, you need to check whether subsequent events that require adjustment have been properly reflected, whether if there are any subsequent events that to adjusting subsequent events are there, whether they are properly reflected in the financial statements or not, you need to check. And in case if you came to know about any subsequent event after the date of auditor's report, you have to respond appropriately. How to respond appropriately, that's what we are going to learn. And whatever it is, first you need to find out subsequent events are there or not. First, how you will get to, in order to know whether there is a subsequent event or not, to know that you need to perform some procedures. So what audit procedures you will perform to know whether subsequent events are there or not? So we have a list here, as you could see. First, you should go and understand what procedures management has followed to identify the subsequent events. See, before the auditor, management is having a responsibility to identify the subsequent events. So first go and ask the management what procedures they have performed to identify subsequent events. And also go and inquire with management and those charged with governance. Did they find any subsequent events? And also read the minutes of the meeting of board of directors and shareholders, especially which have taken place after the date of financial statements. Read the interim financial statements, quarterly financial statements, if they are ready, read them, or even obtain written representation. So you perform all these steps and you have to find out the subsequent events. Now you will find out the subsequent events, and there might be two cases. See, you have found out a subsequent event after the date of auditor's report. You gave the audit report on 15th of April. After giving the audit report, you got to know about subsequent event. But by the time you got to know about subsequent event, financial statements are not yet issued. Financial statements have not fallen in third parties' hands. That is one case. Second case is you have got to know about subsequent event after the date of auditor's report. But by the time you have got to know about the subsequent event, the financial statements have already been issued. The financial statements are already in the hands of the third parties. Which one is more complicated? Second case is more complicated. First case is somewhat better. Why? Because you got to know about subsequent event, but the financial statements did not reach anybody. So the moment financial statements reach the third parties, then the things get complicated. So first we will talk about the easy case, facts which became known to the auditor after the date of auditor's report, but before the financial statements are issued. Generally, if you came to know about, generally whatever things which take place after the date of auditor's report, you are not required to worry about it. You don't need to do anything. But in case if you came to know about any fact, and if you feel that if this I have known at the time of auditor's report, I would have given a different audit report. If such a fact comes to your knowledge, then you should perform these procedures. So you got to know about subsequent event, but by the time you got to know about subsequent event, financial statements are not yet issued. What you should do? So what you should do here is three things you should do. Number one, first go and discuss the matter with management. Go and discuss with the management. Sir, I got to know about subsequent event. What we shall do? Discuss with the management. Determine whether financial statements need amendment. As a part of the discussion, you please determine is that an adjusting event or non-adjusting event. Why? Because only when it is adjusting, then only it requires amendment of the financial statements. So arrange a discussion with the management, discuss with them, determine as a part of the discussion whether financial statements need amendment, and if financial statements need amendment, if you have decided that financial statements need amendment, you have to inquire whether management is ready to amend that financial statements or not. You have to inquire them whether the management is ready to amend financial statements. Now, two outcomes could be possible. First, three things. What you will do? Number one, discuss with the management. Number two, determine whether financial statements need amendment. If needed amendment, then you need to determine whether management is ready to do it or not. Two outcomes could be possible. What are they? Management agrees to amend the financial statements. If the management agrees to amend the financial statements, happy. But you should do one thing. What you should do? You should perform extra procedures to check whether they have done the amendment properly or not. The management says, yes, sir, we have done the amendment. You can't blindly believe no. So you should check at least once whether they have done the amendment properly or not. You need to perform audit procedures. You need to obtain audit evidence regarding that amendment. If everything is okay, you will give unmodified opinion, no issue. That means old opinion itself will become relevant. But you have to do one small change here. You have to do one small change. So management has amended the financial statements, and it is you are happy that they did the amendment also properly, but you are not required to give any kind of modified opinion. The old report is still valid, but one slight change you have to do. Date you have to change. Why? Because previously management approved the financial statements on 10th of April. I gave the audit report on 15th of April. Now we got to know about subsequent event. Management amended the financial statements. These amended financial statements will once again be approved. Say for example, these are approved once again on 20th of April. So now that is other case, no? So 20th of April they have amended and they have approved it. The old audit report content and all wise it's same, but I can't give the old audit report. Why? I have mentioned the date as 15th of April. So what I should do? Keep the entire report as it is, just to change the date and give the audit report. Clear? Able to understand? So what we have seen, once again, if you understand the cycle here, discuss with the management, determine whether they need amendment. If financial statements need amendment, inquire. Management agrees to amend, perform the audit procedures on the amendment, try to obtain sufficient and appropriate audit evidence, and then finally there is no impact on the opinion. Old audit report will still remain valid, but only one thing you are required to do, change the date. Now the problem comes. What is the problem? Management is not ready to amend the financial statements. If the management is not ready to amend the financial statements, now also here there could be two cases. See, now you can't give the old audit report. What you should do? You should give a modified opinion. Why? Because management is not amending financial statements. You have to definitely give a new audit report. But here also there could be two cases. You signed audit report. Audit report is ready, but you have not yet handed over that audit report to the client. You signed audit report. Say for example, on 15th of April you have signed. You thought tomorrow I will come and give that audit report to my client. But before you could give that audit report to the client, you got to know about subsequent event, discussed with the management. Management is not ready to amend the financial statements. You are in a favorable position here. Why favorable position? The report is still with you. You did not give it to the management. What you will do here? Whatever old audit report is there, you throw it away. You give a new audit report. In that, give a modified opinion, add your signature, affix your UDIN and all, and give that new audit report. But in some cases, so if you see this, management does not amend the financial statements, but there are also two cases. Audit report is not yet given to management. Then what we do? modify the opinion and give the audit report. What is the other case? By the time you came to know about subsequent event and all, audit report has already been given to the management. So I have given the audit report to the management. I got to know about subsequent event. That subsequent event needs amendment of the financial statements. Management is not amending. Now what I should do? First thing what you should do is you should instruct the management not to circulate audit report. Don't circulate the audit report until my further notice. Then what if without listening to you, if the management has still circulated, what you should do? You have to take appropriate action to stop the people from relying on the auditor's report. Whatever action you will take, that you will decide. So you have to take the appropriate action, whatever it is. Take appropriate action and stop the circulation. And anyhow, so you should stop the circulation. If first you should instruct the management not to circulate. If circulated, please take the action to stop the circulation. Then what you should do? Give a new audit report which contains a modified opinion and ask them to circulate this new audit report now. So this is what, in case if you came to know about subsequent event before the financial statements are issued. Now let us come to the another case. What is another case? You came to know about subsequent event, but by the time you came to know about subsequent event, financial statements are already issued. They have fallen in the hands of the third parties. Here what you will do? Here also the same three things we will do. First we will go and discuss with management. Then we will determine whether financial statements need amendment and inquire whether management is ready to amend the financial statements or not. But before that, what you should do is, if you have decided financial statements need amendment, whatever audit report which is there with the shareholders, that is not a valid one. So first you should go and ask the management that take some appropriate action to stop the people from relying on the audit report and the financial statements. What you should do? You should go to the management and ask them, sir, please stop the movement, please stop the people from relying on the audit report and the financial statements. If the management does not take any action, then what you should do? Auditor himself should take an action to stop the people from relying on auditor's report. Understood? So whatever it is, first stop the people from relying on auditor's report. Either you do it or management will do it. Someone has to do it. Then after that, once again, I will see whether management is agreeing to amend the financial statements or not. If the management does not, if the management agrees to amend the financial statements, well and good. What I will do? I will perform the audit procedures, whether they have done the amendment properly or not. I will try to obtain audit evidence. Then I will give new audit report. I will give which contains unmodified opinion only, because they have changed. No, and here the standard specifically says you will give unmodified opinion. Now this audit report will go. Amended financial statements will go once again. But the shareholders already have a copy of the financial statements and the audit report. Now if you send them new copy of the audit report and financial statements, they get confused why we are getting two copies of the financial statements and two audit reports. So in order to sort out, in order to help that shareholders, what you do is you either use an emphasis of matter paragraph or other matter paragraph, mainly emphasis or other, whatever it is. You use that emphasis of matter paragraph or other matter paragraph, and there you highlight. What you do? There you highlight what is the difference between this new set of financial statements and the older set of financial statements. Just highlight it. You give unmodified, but highlight it. What if the management doesn't agree to amend the financial statements? What if the management is not agreeing to amend the financial statements? Anyhow, you will give a new audit report, give a modified opinion. Reason for that modified opinion, you will explain it in basis for modified opinion paragraph. Here also, are you required to make use of any emphasis of matter or other matter paragraph? No, you are not required to use any emphasis of matter or other matter paragraph. Okay, everybody with me? Shall we proceed further? Right. So this is what regarding SA 560. So with this, we have completed all the 500 series of standards. See one small thing, one small point missed out. See once again, if you come back to SA 570, one small point I missed out. In SA 570, reporting requirements are there, no? We have seen two cases. Going concern is valid, going concern is invalid, material uncertainty relating to going concern. Now one slight change there, not change actually, addition. So if you come to this, going concern becoming invalid. If the going concern is invalid, there also we try to check whether there is an appropriate disclosure or not. If there is an adequate disclosure, what we do? Unmodified opinion we will give. If there is no adequate disclosure, what we do? Directly we give adverse. See, even in the case of material uncertainty also, if you are modifying, if there is a adequate disclosure, we are giving unmodified. But in order to bring that matter to the shareholders' attention, we are highlighting that there is a material uncertainty. Where we are highlighting it? In a dedicated paragraph called material uncertainty relating to going concern. Don't you think here also there is a need? Going concern is inappropriate. Going concern is invalid. Entity will not continue for the foreseeable future. Management has given an adequate disclosure also without their fault. I have given an unmodified opinion. But don't you think here also there is a need to highlight this information to the shareholders in the auditor's report? Yes. How to highlight it? Here they have told use the emphasis. Here there is no need to use any separate paragraph. Here you can highlight that in which paragraph? In the emphasis of matter paragraph, you can highlight it. Understood? Only for highlighting material uncertainty, we use material uncertainty relating to going concern paragraph. But for the purpose of highlighting inappropriateness of the going concern assumption, no need to use any separate paragraph. You can highlight it in emphasis of matter paragraph. Understood? Right. So this one small point I missed out. So with this, we have completed all the 500 series. Okay. Fine. So now what we will do is we will try to do SA 260, SA 260, 265. We will try to complete them. Very small standards and very easy standards. SA 260 talks about communication with those charged with governance. So you are required to fulfill some communication with those charged with governance. You are required to communicate some matters with those charged with governance. So what matters you are required to communicate? But first of all, before we can understand what matters are required to be communicated, we should understand who are those charged with governance. This is some complex definition. When I say those charged with governance, they say some definition. That definition will add confusion, will not give clarity. Like if you read the definition, whatever they have given in the standard, those charged with governance are those persons or organizations with a responsibility for overseeing strategic direction and also obligations related to, understood, no? Understood. So they say that they are basically looking after overseeing the strategic direction. That means they provide the strategic direction for the company. That means they look after strategical matters of the company, and also they have obligations relating to accountability. Accountability in the sense being responsible for their actions. Now, in order to make you understand this, who will fall under those charged with governance? Let me give you one simple example. From a common perspective, I will give one example. Say, for example, there is say myself, I have one business idea. I have one business idea. I want to start a restaurant. I have one excellent dish and all I have. So something I have some ambience I have thought of and all. So definitely I know that restaurant will work well. So I want to start a restaurant. But I'm already occupied now. Already occupied. I'm taking up these classes. I have a practice to take care. So I will not be able to sit there and manage the business. But I know that is an excellent idea. So what I have done is I have created a restaurant. I have started a restaurant. Now, in this restaurant, various operations are required to be taken care of, like everyday groceries and all they have to buy, they have to look after the cooking, they have to serve the customers, billing, multiple functions is required to be taken care. So now what I have done is, since I am unable to spend all the time, I have appointed one manager. At my restaurant, I have appointed one manager. Now this manager will look after day-to-day operations. He will buy or he will take care of all the groceries and all. He will manage the chefs. He will also manage the customers. He will do billing. He will coordinate with the auditors and all. So every business activity will be managed by this function, managed by this person. And I'm calling him manager. So management basically is a term which refers to the people who have the execution responsibility, who executes, who make the things happen, not by themselves. They're responsible for execution. They don't actually execute. When I say management will prepare financial statements, board of directors will not sit and prepare financial statements. They will make sure that financial statements are prepared. They have to make it happen, but they will get it done with the help of staff. So here also, I have started a restaurant for this organization. I have given the execution responsibility to my manager. Now this person will fall under management definition. Okay. Now, if something goes wrong in the restaurant, people will come and blame whom? See, for example, if someone ate a food in the restaurant, Just for example sake, really I have a restaurant idea. Just for example sake, I'm destroying my idea and all. So say for example, one person came to the restaurant, ate the food, some food poison has taken place. Just for example, okay. So very this is he has become extremely sick. He has become extremely sick. So he has filed a complaint against me. So now authorities will come and question whom, or really it's a fault. It's a fault only. Some chef has added something, intentionally has added. I did not pay him salary on time. So on grudge he has done something. So this person has felt very extremely ill. Now police have determined that yes, this is completely fault of the restaurant. They came to arrest. Whom they will arrest? Owner. They will come and arrest me. If I'm sitting in the class, they will come here. They will pick me up. Yes or no? So here accountability. Who has to face the consequences if something goes wrong? Owner. So here I will fall under those charged with governance definition. Not basically owner. I have to face the consequences. So I will fall under those charged with governance definition. And what this manager should do, like strategic decisions, whether to open a new branch or not. If I have to open a new branch, where I have to open the branch. So all that decisions, who will provide the strategic direction? Who will take all the decisions? Will I ask my manager to open the new branch wherever he want? No. I will decide where this new branch is required to be opened, how the fund, what has to be done to the funds. Should I do any interior updation? Should I open it? Should I add few more items in the menu or not? That all strategic direction will be taken by me. So I will fall under those charged with governance definition. So I am the person with the responsibility for overseeing strategic direction, and I'm also have obligations relating to accountability. So I will fall under those charged with governance. This person will fall under management. Management has the execution responsibility. Easy to understand till here. But this difference between management and those charged with governance becomes very thin in the case of companies. In the case of companies, say for example, there is one company, 99% of the companies you will not be able to find the difference between management and those charged with governance. Say for example, I will give you how in company it will work. Say for example, there are some promoters in the company. These promoters have started the company. They are just investors. They are just investors. They don't take any execution responsibility. They just will decide out of the funds of the company what they are supposed to do, whether they have to expand or not. Only that decisions they will take. But when I say company, in company many functions will be there. Like there should be one finance thing. Finance people should be there who has to take care of that financial statements, preparation of books of accounts, and there will be operations. There will be HR related functions. There will be some various other functions. So now what these promoters have done is they have appointed some directors. So there is a CFO who will look after financial statements and all. There is one CEO. They have appointed one CEO who will look after that operations and all. They have appointed one. They have appointed one director of HR department who will look after the HR related things and all. So like that, they have appointed these people, CEO, CFO, directors and all. They have appointed. Now these are the people who have the execution responsibility. So these will fall under what? Management. Whereas these are promoters who are providing the strategic direction and all, they will fall under what? Those charged with governance. But in majority of the companies, what will happen is there will be promoters, there will be founders. They will start the company with their own money, and what in fact they do is they only will take the positions in the operations also. They only will take the responsibilities also. Like for example, four people have started a company, and these four people, each person has become one director. So one person is a CFO who is looking after finance, one person is a CEO who is looking after something, one person is a managing director, one person is a whole-time director. Like generally whoever own the company, they only also will pick up execution responsibility. So in those cases, both management and those charged with governance, both the roles are played by same category of the persons. In many organizations, you will not be able to find the difference, especially in companies. So management and those charged with governance, in many companies, both the roles are played by same category of the persons. They will only look after strategic direction. They will only look after execution responsibilities also. Understood, right? So now since we understood who is management, who is those charged with governance, now let us try to understand what are the objectives. So as I have told, as per SA 260, you are required to communicate some matters with what? Those charged with governance. Sir, what matters you are required to communicate? What matters you are required to communicate? That's what in the objectives paragraph. So they say that you are required to communicate with those charged with governance. What are your responsibilities? because many people don't have an understanding what auditor is supposed to do, what management is supposed to do. They don't know. So that's why it is your mandatory responsibility to go and communicate with those charged with governance. What are your responsibilities, and also overview of planned scope and timing of the audit. Not detailed plan, scope and timing of the audit. You should not say detailed plan to them, sir, this is what I'm going to do, keep a copy of the audit plan with you. You should not do that. Just you have to give a overview of the plan, scope and timing of the audit. And also, in case if you require information from those charged with governance, it is your responsibility to obtain relevant information also. It is not one-way communication. When I say communication, two-way communication. You are also required to communicate some things with those charged with governance. If you require any information, you should be able to get that information from those charged with governance. And also provide those charged with governance with timely observations. So whatever your observations are there, those observations on a timely manner, you are required to communicate with them. And you have to promote a effective two-way communication. So 4 objectives. Number 1, you have to communicate with them, responsibilities and overview of planned scope and timing of the audit. You need to obtain relevant information. Number 3, you need to provide them with timely observations, and you should ensure that there is a two-way communication. Now they talk about each point in a detailed manner. Sir, you told I have to communicate my responsibilities. What responsibilities I have to communicate? Simply 2 things. You have to communicate that you are responsible for forming and expressing an opinion. And just because auditor is appointed, that will not relieve the management of their responsibilities. What do I mean by that? Just because you have appointed me, you should go to the management and say, sir, your responsibilities will still be there. Even though you have appointed me as an auditor, that will not reduce any of your responsibilities. Your responsibilities are yours, my responsibility is mine. Just because you have appointed me, there will be no reduction on your responsibilities. Tomorrow, don't come and ask me to prepare the financial statements. So this is what you are required to communicate. So you have to go and communicate with him, communicate with the management that you are only responsible for forming and expressing an opinion, and in no way that will relieve the management of their responsibilities. And also, I told you have to explain them about planned scope and timing of audit. But once again, I have told overview. What I have told, overview of planned scope and timing, you have to communicate. Along with, you have to communicate with them significant risk also. What and all are significant risk that you have to communicate. And in addition to that, I have told you have to provide them with timely observations. No, not every observation. You will try to communicate only significant findings. Major findings you have to report, not each and every matter. Sir, what could be significant findings? A few examples they have given. Significant qualitative aspects like accounting policies related information and all that you can communicate. Inappropriateness of accounting policy. If you find any accounting policy which the management is following is inappropriate, wrong accounting policy they are following, go and communicate with them. Significant difficulties encountered. The management is putting a difficulty on your work. You want to go and communicate with them. Go and communicate. Unless all of those charged with governance are involved in the management. That means if management and those charged with governance both are same, then no need to do this. When management and those charged with governance both the roles are played by same person, this point will not become applicable. If management is different and those charged with governance is different, then you need to communicate something extra to those charged with governance. What you have to communicate? Number 1, whatever matters you have discussed with the management, whatever written representations you have requested from the management. But if management and those charged with governance both are same, what is the purpose in communicating? Basically, whatever you have communicated with the management, that they are asking you to communicate with those charged with governance once again. When this will happen? When both the roles are played by 2 different categories of person. When both are same, what is the purpose? Anyhow, one communication you have done? No. Next. Circumstances that affect the form and content of the auditor's report. Because of what reasons your opinion might change. What factors affect your form and content of the report. So that also you have to communicate. And all other significant matters as per professional judgment of the auditor. So any other matter, whatever you feel it as, per your professional judgment, you have to communicate. So these are all the significant findings which you are required to communicate. And especially in case if you are conducting an audit of a listed entity, you are required to compulsorily communicate regarding auditor's independence. Mandatory. So if in case of a listed company, you are required to communicate regarding auditor's independence. So what communication you have to do? That auditor shall communicate engagement team, not just engagement partner, engagement team, firm, and also the networking firm. Everybody has complied with ethical requirements. And also you have to communicate with them whether there are any such relationships which might affect your independence. Like if you are providing any audit services for your subsidiary associate, or you are providing any non-audit services to the clients or the related entities, what fees you are charging for audit purposes, what fees you are charging for non-audit purposes. Basically, if any relationships you have that affect independence, all that things are also required to be communicated, and this is mandatory only in the case of listed entities. And what is the communication process? When I say communicate, how you will communicate? In the written format, generally in written format. But what the standard says is, in case of listed entities, compulsorily in writing. In case of other entities, you can do it orally also. If you find that oral is inadequate, then you have to do written communication. But generally, oral will always be inadequate only. Oral communication will always be an inadequate communication. So we have to do everywhere written communication only. And whatever matters that you have communicated with those charged with governance, all that matters are required to be included in your audit documentation. Okay, comfortable? Shall we proceed? Next. Coming to the next one. SA 265. SA 265 talks about communicating deficiencies in internal control to those charged with governance and management. So whatever deficiencies you have, that has to be communicated. Basically, what this standard says is, if you have a normal deficiency in internal control, communicate with management. If you have a significant deficiency, that you communicate with those charged with governance. That's what the standard says. If you have a normal deficiency, communicate with management. If you have a significant deficiency, communicate with those charged with governance. But before that, we need to understand what is a what is a deficiency, what is a significant deficiency. So what is the meaning of deficiency? Control is designed, implemented, or operated in such a way that it is unable to prevent, detect, or correct a misstatement. You have implemented internal control, but it is unable to prevent, detect, or correct a misstatement. Or you don't have altogether internal control. Internal control itself is missing. Even if you don't have internal control also, we call it as a deficiency. You have internal control, but it is designed, implemented in such a way that it is unable to prevent a misstatement. Then also we call it as a deficiency in the internal control. Clear? Now, what is significant deficiency? A deficiency or a combination of deficiency which you feel it as sufficiently important to bring it to the attention of those charged with governance. There will be various deficiencies, but every deficiency doesn't require bringing it to the attention of those charged with governance. If you find any deficiencies or combination of deficiencies, and if you feel that these should be brought to the attention of those charged with governance, those deficiencies we call them as significant deficiencies. Understood? Next. So examples of matters that the auditor may consider whether a deficiency is a significant deficiency or not. Sir, how you will decide whether a deficiency is a significant deficiency or not? What factors you are going to consider? These are the factors which I will consider. I will consider likelihood of deficiencies. Depending on likelihood of deficiencies, I will decide. And also whether it is fraud or whether it is having a chance of fraud. If it is having a chance of fraud, the deficiency will be a significant deficiency. And also degree of subjectivity or complexity is involved in the amounts. If the amounts are very complex, if the amounts are very subjective, so many judgments are involved, in those areas risk is there, that risk will be significant risk. And also financial statement amount exposed to deficiency because of weakness in the internal control, some financial statement is exposed to deficiency. What is the amount of that item? If the amount is very big, significant deficiency. It also depends on volume of activity exposed to deficiency. Through that internal control, how many activities are getting processed? If so many activities are going through that deficiency, that will be a significant deficiency. So all these factors auditor will consider, then he will take a decision whether the deficiency or a combination of deficiency, is it a significant or not. Next one. And they have given indicators. There are some indicators which will give a hint to the auditor that there could be significant deficiency. So what are the factors which give a hint? Number one, ineffective aspects of control environment. What is control environment? We have seen the risk assessment in internal control chapter. What is control environment? Culture of honesty and ethical behavior. You find that in the organization there is no good control environment. People are not honest, people are not having ethical behavior. So that will clearly indicate there is a significant deficiency, like significant transaction in which management is financially interested. So many transactions are happening where board of directors are having a lot of interest. Or identification of management fraud. I came to know there is a management fraud. Management itself has committed a fraud. Or no remedial action for significant deficiencies. Even after coming to know about deficiencies also, no actions are getting taken. These things indicate ineffective control environment, and ineffective control environment will indicate a significant deficiency. Next, absence of ineffective risk assessment process. Basically, management is not at all studying their organization only. Where risk is there, where risk is not there, they are least bothered. Next, ineffective response to identified signified risk. Even after identifying significant risks also, they are not taking any action. And misstatements which are not prevented, detected, or corrected by internal controls. You are finding plenty of misstatements which are not getting prevented, detected, or corrected by internal controls. Disclosure of fraud or error as a prior period item. They found out a fraud, but in order to hide it, they are showing it as a prior period item. Or management's inability to oversee preparation of financial statements. Management is not having knowledge to look after financial statements. That is a very good opportunity for the people who want to commit a bigger frauds. So these are all the indicators. As an auditor, if you come across these circumstances, there is a hint which should come into your mind. Okay, since this thing is that there is a possibility of significant deficiency. And whatever deficiencies in the internal controls are there that you are required to communicate, as I have told, you have to communicate with those charged with governance what significant deficiency, and communicate with management what. First we will communicate normal deficiencies, but before communicating significant deficiency with those charged with governance, you will also communicate them with management. Because sometimes you might have a notion that it is a significant deficiency, but after you discuss with the management, your perspective can change. You might had a wrong understanding. So that's why before you communicate that significant deficiency with those charged with governance, you are required to communicate with management also once, unless you feel it is inappropriate. Sometimes you might feel that if I go and disclose first to the management before the information goes to those charged with governance, they might do some manipulation. Then you should not communicate. Then you have to directly go to those charged with governance. Next, written communication of significant deficiencies should include. So whenever you are communicating significant deficiencies to those charged with governance, what and all should be included in that communication? You have to describe the deficiencies and their potential effects. What deficiencies you have identified, because of that what impact could be there. Not just that, in addition to that, you should also provide those charged with governance with sufficient information to enable them to understand the context of communication. See, in most of the cases, no, those charged with governance will contain those people who are not at all aware of who are not at all aware of all these things. Why? Because see, those charged with governance are basically business people. We can't expect them to be so much educated, or even if they are educated, you can't expect them to know about our financial terminology. If you give them a report, deficiency, significant deficiency, blah blah blah, they will say okay, oh, so much of information. But once you leave the room, no, they will throw it in the dustbin because they will not understand. No. So that's why don't just let them know deficiencies, provide them with all the sufficient information. Just explain them. So deficiency means weakness in the internal control. Significant is this is very much bigger deficiency because of which in your organization these things are happening. So like that, provide them with all the sufficient information to make them understand that significance. And in particular, the auditor shall explain purpose of the audit, and it is to express an opinion. In addition to reporting significant deficiency, you tell them one more thing. Sir, my objective is not to report on internal controls. My objective is to what? Form an opinion on the financial statements. As a part of that responsibility, I verified a few controls. By verifying that controls, some deficiencies has come to my knowledge that I have reported. And these might not be only deficiencies. If we would have dig deeper, there might be other deficiencies also. I am just communicating with you whatever has come to my attention as a part of my broader objective of expressing an opinion on the financial statements. Whatever has come to my attention, that I am reporting. And these might not be only deficiencies. If you do a further investigation of your own organization, you can even find more deficiencies also. So that you have to go and communicate, that you have to mention in your that report through which you are communicating the significant deficiency. So this is what regarding SA 265. So 260, 265 we are done. So now we will try to do SA 450. So for this chart should be there, but I'm unable to find that chart where I have kept it. It might be in my other laptop. I will go and check. So but I will try to cover it from here. From the material we'll try to go small standard only, easy one. Okay, so let us try to complete essay 450 also. You want break now? No, right? No. 450 we will complete. Then after that we will see if required. If I require, I will give. Fine. So essay 450 talking about evaluation of misstatements identified during the audit. So now just I will tell you overall structure. Here there is nothing so complicated. Just we need to understand the entire sequence in the audit once again. So what is a misstatement? Do you guys remember? What is a misstatement? Did I define the term misstatement? Please define that for me. A difference in amount, classification, presentation, disclosure, which is there in reported financial statements, and the amount, classification, presentation, disclosure required as per applicable financial reporting framework. That we call it as misstatement. And the misstatement can happen because of fraud, and it can happen because of error also. And one of the main objective of the auditor is you need to express an opinion whether financial statements are free from material misstatements. Basically, what will happen is when you start performing audit procedures, so you will perform audit procedures. By performing the audit procedures, you will find out misstatements. The whole objective of performing audit procedures is to find out whether misstatements are there or not. So you will start performing audit procedures, you will find out the misstatements. Now, what we should do to that misstatements? What we should do to that misstatements? So first, what we should do is what and all misstatements we have identified, we have to accumulate all that misstatements. What we should do? Accumulate all that misstatements. Unless those misstatements which are clearly trivial, you have to accumulate all the misstatements except those which are clearly trivial. Clearly trivial means which are clearly negligible, that you need not accumulate, that you can completely ignore it. Say for example, I am conducting audit of Reliance Industries Limited. I found out that there is a 500 rupees of fraud has taken place in the Reliance Industries Limited. Will I accumulate that also? No. So if you find out, first you will find out all the misstatements. Out of all the misstatements, whatever misstatements you found it as clearly trivial, clearly negligible, that you will ignore, that you will not accumulate. So other than clearly trivial, whatever misstatements are there, all that misstatements you are going to accumulate. Now, after you have accumulated all the misstatements, first what you should do is you should go and communicate all that misstatements with the management. What we should do? We should go and communicate all that misstatements with the management. See, whatever misstatements we have identified, that could be because of errors also. Just because if you find an error, you should not go and say, I found so many errors, I will give a modified opinion. No. You have to go and communicate with the management, give them an opportunity to correct that misstatements. The misstatements might mistake when a misstatement has happened, that doesn't always indicate a fraudulent intention. There could be some human errors also because of which errors could have taken place. So whenever you have found all that misstatements, first you have to accumulate other than which are clearly trivial, go and communicate with the management and ask them to correct that misstatements. So now once you have went and communicated all that misstatements with the management and you ask them to correct it, they might have done few things. Number one, what they can do is they could correct all the misstatements. They would correct all the misstatements. Well and good, fine. In some cases, they might say, no, we will not correct any of the misstatement. They did not correct even a single misstatement. Or in some cases, what they will do is they will correct a few misstatements. They will not correct a few misstatements. See, first case is the only favorable case where they have corrected all the misstatements. That is a good scenario. We need not modify any opinion. In case if they have not corrected all the misstatements, so first I will go and request them. I ask them to correct the misstatements. If they are not correcting the misstatements, then take one more opportunity, go and communicate with those charged with governance and tell them, sir, your management is not correcting the misstatements. Please do correct them. If after that also correction is not happening, so whatever uncorrected misstatements are there, the total amount of uncorrected misstatements that I will compare with the materiality level which I have decided. Whatever total uncorrected misstatements are there, that I will try to compare with the materiality level. If the total of uncorrected misstatements has exceeded my materiality level, I will modify my opinion. If the total of uncorrected misstatements did not exceed my materiality level, if it is within the materiality level, I will not modify my opinion. That's all. Clear? So once again, if I tell you entire steps, you identify misstatements, you accumulate the misstatements except those misstatements which are clearly trivial. and whatever misstatements you have accumulated, communicate with the management, ask them to correct it. If they correct it, well and good. Whatever uncorrected misstatements are there, that you compare it with the materiality level, and if they have exceeded the materiality level, give a modified opinion. Understood? So this only they try to stretch it a bit further. So with so many complex sentences and all. So quickly we will try to cover. So the objectives of the auditor. What are objectives of auditor? Number one, you have to evaluate effect of identified misstatements and also the effect of uncorrected misstatements. Both we have covered. So first, as I have told, you have to accumulate all the misstatements identified during the audit, but other than clearly trivial, those misstatements which are clearly trivial, clearly negligible, that you can ignore. Apart from that, all other misstatements you have to accumulate. Now you have to consider identified misstatements as and when the audit progresses. Throughout the audit, you have to remain alert for misstatements. So the auditor shall determine whether overall audit strategy and audit plan need to be revised. Sometimes what you think is, in the plan and strategy you have decided smaller samples, but in the small samples only you are able to find so many misstatements. Then you might be required to revise your strategy to increase your checking. So you might be required to revise your audit strategy and plan when the nature of identified misstatements indicate that other misstatements may exist. You found misstatements and there is a strong conviction that if I verify more, I will be able to find out other kind of misstatements also. Then go and make changes to your strategy and plan. Increase the testing, find out that other misstatements also. Or the aggregate of the misstatements during the audit approaches materiality. You have found out so many misstatements that did not exceed, but it has come very closer to materiality. Generally, you do it on the sampling basis. On sampling basis only, you have found out the misstatements which are closer to materiality. Now, if you do little bit of extra testing, might be actual misstatement might go beyond my materiality level, and you could avoid giving a wrong opinion. So that's why in these two cases, you make changes to your strategy and plan. When identified misstatements indicate there could be other misstatements, or the accumulated misstatements approach the materiality level. And also, the auditor may request the management to examine a class of transactions, account balances, to understand the cause of misstatement. In case if you have found misstatement, same misstatement is getting repeated, ask the management why the same misstatement is happening and again, and ask them to evaluate the reason and ask them to rectify it. Next. If at the auditor's request, management has examined and corrected the misstatement, you check once whether really management has corrected the misstatements in a proper way or not. Then, once you have accumulated, what we should do? Communication. Ask them, communicate with them and ask them to correct it. So the auditor shall communicate on a timely basis unless it is prohibited by law or regulation. If there is a prohibition from law or regulation, don't communicate. If there is no prohibition from law or regulation, you have to communicate. The auditor shall request management to correct the misstatements. So, and it enables the management to evaluate whether items are misstatements or not, and if it disagrees, take necessary action. See, when you go and communicate with the management, whatever misstatements you have identified, sometimes management will disagree also. No, sir, you are considering it as a misstatement, but it is not actually a misstatement. You felt accounting policy is wrong. Whatever accounting policy the client is following, it is wrong. You went to the management and told. Sometimes what management will do is they will give you justification. No, sir, your understanding is only wrong. Depending on our business, this accounting policy is only correct. So that could change your perception also. So if you go and communicate, either management will correct. If they disagree, they will let you know so that you can update your understanding. Next. And also, if you go and communicate with them, it will enable the management to maintain accurate books and records. If management is refusing to correct the misstatement, first you should obtain understanding of the reasons. First you should ask them why they are not correcting it. If there is a genuine reason, well and good. And also whether financial statements as a whole are free from material misstatements. Because of that non-correction, is the financial statements containing material misstatement. Why? Because that uncorrected misstatement will compare it with the materiality level, no? So that you have to analyze and evaluate the effect of uncorrected misstatement. As I have told, that you have to compare it with the whatever uncorrected misstatements are there, that you have to compare with the materiality level. So you have to consider in aggregate, not separately, the total of all the corrected misstatements you have to consider. And the auditor shall consider size and nature of the misstatements and even uncorrected misstatements related to prior periods. Everything you will consider. And in addition to that, you should also communicate with those charged with garnets. As I have told, if the management is not correcting, you have to give an opportunity to those charged with garnets. Here also, unless prohibited by law or regulation. And you should request them to correct that misstatements. And also to them also you communicate whether any uncorrected misstatements are there which are related to prior periods. And even you ask them written representation. When you ask them written representation is if the management is not correcting the material misstatements. They are arguing, sir, no, sir, this is not a misstatement. We will not correct it. They will tell you some reasons and all. Don't just hear that listens. Don't just listen to that reasons. Ask them to write that results in a written representation. Next. And whatever misstatements you have identified, how many corrected, how many not corrected, on what basis you have decided the misstatements as trivial. I told clearly trivial misstatements should be ignored. On what basis you have decided which is trivial, which is not trivial. So all that things should form part of audit documentation. Clear? So with this we have completed even SA 450 also. Okay. How many more standards we are left with? Four. Two only, no? Five. I 525 30, leave it. Audit sampling, analytical procedures, dedicated chapters. 320 audit strategy planning and program, that I will cover there. 220 is there. SQC 1 is there. 610 also I told I will give you a brief and all. Okay. So shall we take a break now? Okay. So let us take one short break for 10 minutes. Please come back to that. So first, let me give you one brief. What does SA 220 and SQC 1 talks about? Both are talking about the quality control only. So like as I've told you in the introduction to this chapter, when we had introduction to this chapter, that auditor will do different kinds of engagements. So sometimes he will do audit, sometimes he will do review, sometimes he will do assurance, sometimes he perform related services. All these are different kinds of engagements which a chartered accountant does, and there's a need for maintaining quality in all that engagements. So for ensuring the quality in all the engagements, we have a standard called SQC1. So SQC1 provides the guidance to the chartered accountants on how to maintain quality in all kind of engagements. So SQC1 will give guidance how to maintain quality in audit engagements also, in review also, in assurance also, and also at the related services. Basically, SQC1 talks about quality control at the firm level, how overall firm should maintain the quality. Whereas SA 220 is also going to talk about quality control only, but SA 220 talks about quality control in the case of only audit engagement. So if I have to define, if I have to bifurcate it, if I have to tell you pinpointed difference, SQC1 talks about quality control at the firm level. SA 220 talks about the quality control at the audit engagement level. So for every engagement, whatever you are doing, for every audit engagement, how you have to maintain quality, that is guided by SA 220. For all engagements which a firm does, how to maintain the quality, that will be explained by SQC1. Both are structured on the same lines. Actually, SA 220 has been taken from SQC1 only. SA 220 has been taken from SQC1. Why? Because SQC1 is talking about overall quality and SA 220 is talking about only quality on audit engagement. So first we will start with SQC1. As you could see, SQC1 talks about quality control for firms. It is talking about the entire audit firm that performs audits, review of historical financial information, other assurance services, and even related services engagement. So whatever engagements you do, be it audit, be it review, be it assurance, be it related services, for all the engagements, how to maintain the quality, that is governed by SQC1. Then, and SQC1 says that in order to maintain quality in all the engagements we are doing, you need to follow some principles. You need to follow some principles, and that principles are required to be implemented in 6 elements. How many elements? 6 elements are there. In 6 areas of your firm, you need to follow some policies and principles. Sir, what are that 6 areas in which I have to maintain the quality, in which I have to follow some principles? That 6 areas, we call them as elements of system of quality control also we call it. So there are 6 areas in the firm in which you have to follow some policies and procedures, then automatically quality will be ensured for all the engagements. So what are that 6 elements of system of quality control? Number 1, leadership responsibility for quality within the firm. Number 2, ethical requirements. Number 3, acceptance and continuation of client relationship. Number 4, human resources. Number 5, engagement performance and monitoring. So in these 6 areas, you need to maintain policies and procedures. What are the 6 elements? Number one, leadership quality, leadership responsibility for quality within the firm, ethical requirements, acceptance and continuation of client relationship, human resources, engagement, performance, and monitoring. So what does this each of the points say? What kind of policies we need to have in each of this element? Let us try to have a quick look. Starting with the first one, leadership responsibility within the quality. See, if you give the responsibility for maintaining the quality to everybody, no one will make sure that quality is maintained. If I give a task and I say each and every one of you in the class will be responsible for completing that one task, high chances no one will do that task. That task will remain unfinished one. But on the other hand, if I give someone a leadership responsibility, so I am making you a leader, you have to make sure that this task has to get completed on time. There are more chances that task being completed on time. Same thing happens even with the quality also. If I say entire firm is responsible for quality, no one will maintain. Someone should come forward and take the leadership responsibility. Okay, I will take the responsibility. I will act as a leader for making sure that my firm complies with quality norms. Sir, who should be that someone? No, that is for auditor. The leadership responsibility in the firm for all engagements, who has to come forward and take the leadership responsibility is the chief CEO, firm's CEO or managing partners to come forward and assume the ultimate responsibility. I'm not talking from audit perspective, I'm talking from the entire firm perspective. So for a firm, if they have to ensure quality, someone should come forward and take the leadership responsibility. Who should be that? CEO or managing partners. Not just them, they have to assign operational responsibilities to those people who have appropriate experience, ability, and authority. Then only quality will come. Just if the CEO come forward and take the leadership responsibility, quality will not be ensured. So whenever he is assigning the work to others, he should assign the work to such people who have appropriate experience, ability, and authority. So if you take the steps, the quality can be ensured. So that is what the leadership responsibility. Now coming to the second point, ethical requirements. You have to make sure that the entire firm, including your engagement team members, everybody should comply with the 5 ethical requirements along with the independence requirements. Like if you see, the firm should establish policies and procedures that provide reasonable assurance that its personnel comply with ethical requirements. Not just the top people, even all the members, even staff also, article assistants, everybody should comply with the ethical requirements. And 5 ethical requirements, what are they? Integrity, objectivity, professional competence and behavior, professional competence and due care, confidentiality and professional behavior. And in addition to that 5 ethical requirements, what also should be followed? Independence, which is a basic requirement. And firms should communicate independence requirements with personnel. So new article assistants will come in the firm. They will not know how to comply with ethical requirements, what to do if they come across ethical requirements, because everybody will not be like you sincerely listening to the auditing lectures, no? Right. So that's why you have to educate to all your personnel that maintaining independence is very important. And also identify the circumstances that create a threat to independence. Once again, go back to nature, objective, and scope. So they have to identify, is there any threat to independence? If possible, try to eliminate them or apply the safeguards and keep it at a very low level. And all breaches of independence should be communicated with the firm. If any breach of independence takes place, everybody should go and communicate with the firm. And also at least annually, this is very important for MCQs, at least annually firm should obtain written representation from its personnel regarding compliance with the independence. Every firm should ask from each and every staff whether they have complied with the ethical requirements or not, at least once in a year. Next, so this is the second area, ethical requirements. Third one, third one, acceptance and continuation of client relationship. So before you accept the client relationship, before you say yes or before you continue the client relationship, you need to check certain things. What you need to check? 3 things you need to check. Number 1, integrity of the client. What you need to check? Integrity of the client. Whether your client is an honest person or not. To the extent possible, try to associate with the honest people. But that's where not money comes. But still. So to the extent possible, you have to check before you accept or continue the engagement, you have to check the integrity of the top level management. So integrity of the client, you have to check. Sir, how you will come to know whether your client is honest or not? How you will come to know? So like, as you could see, you have to identify, you have to make a brief inquiry about the reputation, what kind of reputation they enjoy in the market, what kind of operations they are doing, what is their attitude, and whether the client is aggressively concerned with maintaining lower fees. That means they are not treating the auditor correctly. They always say, we will give you 10,000 only, you have to do all the work. So this kind of attitude if they have. And also inappropriate limitation, they are coming and putting a restriction on your scope. or indications of client involvement in money laundering. You came to know the client has previously involved in the money laundering transactions, or reasons for proposed appointment and non-reappointment of the previous auditor. If they're appointing you now, previously who is the auditor, why they have removed him. So like that, by considering all these factors, you determine whether the client is having integrity or not, honesty or not. And one more thing which you need to check is competence to perform engagement. You will check whether client is honest or not. Before you say yes, you should also check whether you are competent to complete the engagement or not. So if you have only some 2-3 resources, you are a newly qualified chartered accountant, you have some 2-3 staff in your office, totally some 4 people are there in your office. You cannot go and accept the listed company engagement. You will not be competent to do it. You need more resources. So before accepting the audit, only check whether you are competent enough. And also check if you are accepting or continuing a client relationship, will you be able to comply with ethical requirements, all the 5 ethical requirements including independence, will you be able to comply with that or not. Check these things, just check these things, then only you say yes to the client relationship. Fourth area in which you need to have policies is human resources, nothing but basically with regard to your HR, so with your staff. So here I have written same as SA 220. Anyhow, I will explain it here itself. So what kind of policies you need to have in the area of human resources? First, at the time of recruitment, you should recruit only those people who are competent enough. If not competent at the time of recruitment, they should have that zeal to become competent. And you have to do periodic evaluation, performance reviews you have to do. If you find someone doing the job in a better manner, complying with independence, ethical requirements, you should honor him. Promote the eligible persons. If you find someone who is lacking in training, provide them enough of training. If you find someone who is not appropriate, who is always doing non-ethical things and all, remove him from the firm. These kind of human resources policies also can make sure that you are maintaining the quality. Next area in which you need to maintain some policies is engagement performance. Sir, what at the time when the engagements are getting performed, then also you need to have some policies. What policies you should have? Like briefing of engagement teams before you go and start doing the audit. Just like that, you should not give the instructions to your staff, go and start doing the audit. You have to brief them what they are supposed to do, what they aren't supposed to do, which standards they have to follow, which process they have to follow to comply with the standards. You have to brief them. And also, if any difficult or contentious matters comes, people should be able to come to you openly and communicate the difficult matters and ask for guidance to you. So that kind of friendly environment you have to create. And also need to consult externally in case of lack of internal resources. Sometimes you might be doing some audit, you need expertise, but you don't have internal people. Like you need a services of a lawyer, you don't have internally any lawyer, then you should not hesitate to go outside and get the help of external resources. Review of significant judgments made in engagement. Before you express your opinion, you have to review once what and all judgments you have made. And engagement quality control review is mandatory for listed entities. What is this engagement quality control review? Just before, after all the audit has been done, after you have performed all audit procedures, after you have obtained all the evidence, just before you express the opinion, someone from the firm or outside of the firm, some competent person should come and check whether the audit has been done properly or not, all procedures are performed properly or not, what judgments you have made. So someone should come forward and check it. After checking only, you have to give the opinion. So that process we call it as what? Engagement quality control review. The name itself says whether the engagement has been done in a qualitative manner or not, that review will happen. Okay, and that is mandatory for when? Only when it is a listed company. And if there is any differences between engagement team and the engagement partner, between engagement partner and engagement quality control reviewer, so if there are any differences, they have to resolve that differences. So like this, when the engagements are getting performed, these kind of policies you should have. And then finally, monitoring. Just by implementing these policies, your things are not assured, quality is not assured. Whatever policies you have implemented till now in all the above areas, whether they are really practically getting implemented, is there any requirement to change any of them? Are you required to update? Are you required to make any changes? So that you have to periodically evaluate also. Understood? So this is what regarding monitoring. So these are the 6 areas in which you need to maintain some policies to ensure that you are maintaining quality. Now, if we talk about SA 220. So SA 220 is talking about quality control only in an audit engagement. Here also they say that if you want to maintain the quality, you have to follow some policies and procedures in 6 elements. What are that 6 elements? Number 1, leadership responsibility, ethical requirements, acceptance and continuation of client relationship, human resources, engagement performance, monitoring of policies and procedures. Like, who will be taking leadership responsibility? For the entire firm, we said managing partners or CEO. But for audit engagement, who should take the leadership responsibility? Engagement partner. And if you want to fulfill the leadership responsibility, just taking the responsibility will not be enough. You have to fulfill it. How you will fulfill it? By way of communication. So as a engagement partner, if you have taken the leadership responsibility for maintaining quality, you should communicate. You should emphasize to your team members what? You should highlight them how important it is to comply with professional standards, how important it is to comply with legal requirements, how important it is to comply with firms quality control policies and procedures, and also how important it is to give appropriate audit reports. And you should create an environment to raise the concerns without fear. Basically, if you just say, if your engagement partner go to the people and say, I am leader, nothing is going to happen. You have to fulfill it. How you are going to fulfill it? Educate your people. Educate them how important it is to do the audit as per standards, as per laws and regulations. Why you have to give appropriate reports. What will happen if you don't give the reports? What will happen? Engagement partner will go and sit in the jail. Don't say that. Engagement partner will go and sit in the jail, but you should not say that to the staff. What you should say, if you do something wrong, we all should go and sit in the jail. Then only they will work. Yes or no? Right. So this is how you have to fulfill the leadership responsibility. Second area, ethical requirements. This anyhow we have discussed. Five ethical requirements we have, including independence. We have 6. Then acceptance and continuation of relationship. This I've already told. Before accepting and continuing client relationship, some factors you have to consider: ability, integrity of the management, competence of engagement team, compliance with ethical requirements. They say one more point here: significant matters arised during the previous assignment. Like last year, you have done the audit for the same client, for the client. Last year, he harassed you. Harassed in the sense, he has harassed you professionally. So, whatever information you are asking, he is not sharing that information. When you are asking information twice or thrice, he is irritating. At one time, he shouted at me. I'm an auditor. He did not care only. I asked for evidence, he shouted at me. And at some point of time, someone came to beat me. So the same entity next time, once the year gets over, the same entity is coming to you and asking, sir, please do the audit for the current year also, sir. Will you do? If I am a person, if I am in that position, I will definitely not do. So you will have to consider any significant matters which have arisen during the previous engagements also, and accordingly take a decision whether to accept the engagement or continue the engagement. Human resources, I have already told, you should have some policies regarding recruitment, performance evaluation, capabilities, competence, career development, promotion, compensation, in all the areas. You should have some policies. And then finally, engagement performance. Here also more or less the same things they say: briefing of objectives briefing of objectives of the work to engagement team, how they have to comply with the standards, direction, supervision, and staff training you have to do, reviewing of the work of engagement team. Whatever work your engagement team has done, don't blindly believe. Review the work of the engagement team, because if your team does wrong, you have to face the consequences. And also you have to maintain proper documentation. If there is no documentation, nothing will help you in the future. And also keep all the procedures and policies current, relevant, and updated. And implementing all these policies alone will not be enough. We need to even monitor also whether these policies are getting operated effectively or not. And also you have to do periodical inspection of completed engagements. Whatever engagements you have done till now, periodically you verify in all that engagements, have we done something wrong, or whatever opinions we have given till now in all the engagements, are they appropriate? So you have to do the periodical reviews also. And also, why monitoring is important? Why we have to monitor? Why can't we implement the policies and ignore it? So you can't ignore it, because if you monitor, then only you will get to know whether you are doing the work as per professional standards and legal and regulatory requirements. Whatever reports you have given, whether it is appropriate or not. Whatever quality control system you have built, is that proper or not? And also follow up by appropriate personnel. So this all will happen only if you do monitoring. So that's why monitoring is the most important step. Just implementation alone will not be enough. Monitoring is very much required. Understood? So this is what regarding 220 and SQC 1. So we will do one thing now. We will start audit strategy, planning, and program. So we'll start that chapter.